Yahoo Finance this Thursday, November 7th. I'm Julie Hyman. That is Josh Lipton. We are moments away from the Federal Reserve's decision on interest rates. We have seen markets rising, stocks rising, but sort of fading a little bit here into the decision, at least from their highs of the session. But for now, continuing the momentum that we saw yesterday.
Yeah, well, listen, I mean, if you were an investor in the stock market, you'd be saying, I've got a resilient economy. Earnings growth's been decent. Now I got good seasonals working for me, and you're looking to a Fed maybe to keep cutting. And of course, the big question is what the path looks like after that.
Right, because the other part of the good equation is that inflation has been slowing down, right? We've got the pace of inflation slowing down, which is the thing that is allowing the Fed to cut. A lot of questions now, given the outcome of the election. What's the economy going to be look like going into next year?
How many questions do you think Powell takes about that, about politics?
Oh, he's going to take the questions.
Oh, yeah.
I don't know if he's going to answer the questions.
I would expect repeated questions from reporters about that. What does he make of the results, the Trump policy agenda? He will then sidestep all of them, but they'll keep coming. You might get annoyed, Jay, frustrated, Jay. I would see that. It's possible.
I think that is a prediction that I feel comfortable with, that you might get a little bit of a frustrated Jay. But he'll also likely get questions about the labor market. Still a lot of confusing signals given the weakness.
And that also
in the
politics
last
interesting, right? Because listen, Trump talks about mass deportations. I think it's a fair question economists can ask about, like, if that really happens, what impact does that have on labor market,
Absolutely.
labor supply, wages, right?
Yeah, all of those are fair questions. To your point, how much Jay Powell will say
Wants
about
to weigh
them.
in? Probably not.
And then, of course, there's also going to be questions about not just today, not just the next meeting, but what the Fed does going into next year. What is the terminal rate? And I think there are a lot of questions about that for everyone about what that terminal rate is going to be. All right, let's go over to our Jennifer Schonberger, who is going to bring us that Federal Reserve decision.
25 basis point rate cut, the Federal Reserve lowering its benchmark interest rate by 0.25% to a new range of 4.5 and 4.75, marking the second cut in just 7 weeks. Officials justifying this new rate cut to maintain their dual mandate of full employment and price stability. However, they did remove key language on inflation in the statement that, quote, the committee has gained greater confidence that inflation is moving sustainably towards 2%, raising questions about the pace and number of future rate cuts. Instead, the policy statement simply reads, quote, the committee judges that the risks to achieving its employment and inflation goals are roughly in balance. No officials noted that the economic outlook is, quote, uncertain and that they are paying close attention to the outlook for inflation and the job market. Other tweaks to the policy statement. The Fed removed the word further in the first paragraph of the statement as regards to progress on inflation, saying that, quote, inflation has simply made progress instead of made further progress toward the committee's objective. The Fed also tweaked language characterizing the job market, noting that conditions in the job market have, quote, eased and that the unemployment rate has moved up but remains low. This decision was unanimous. Back to you.
Thank you, Jennifer. So there's your headlines, Julie. Fed does lower by 25. That was expected. Interesting what they had to say about their goals. Of course, two goals, price stability, full employment. They say roughly in balance, I thought was interesting. Labor market conditions, they say, have generally eased.
Yes. So there wasn't a lot of suspense around the decision today, right? The consensus had really coalesced around this quarter-point cut to rates, and perhaps these tweaks to the language not necessarily surprising either. We should note we are not getting any update to the so-called dot plot today, the summary of economic projections. That's just something that viewers should be aware of. We're not getting that. But to your point, the drama, if there is any, could come from the press conference, which is set to begin in just under 30 minutes here, about how Fed Chair Powell judges the path of inflation from here. Labor improvement, if we are going to continue to see improvement or deterioration, what is that going to look like?
Yeah.
So
the inflation is interesting. So statement removes, as Jennifer just said, this reference to further inflation progress, as inflation has made progress toward that, the 2% objective, but remains somewhat elevated. It's a great question. As you were just saying, listen, headline inflation has fallen. Core is actually more interesting. It's mixed because you had the jump at the start of the year. Now it's slowed, but some questions about where you head from here is core stickier than maybe we thought.
Right, and if you have the risks that are roughly in balance, does that take away the urgency on the part of the Fed to continue cutting, not just in December, but into 2025?
Great question. All right, for more on how markets are reacting to the news, let's get right to Yahoo Finance's very own Jared Blickery. Jared.
Thank you, Josh. We're not seeing a whole lot of movement just yet. And in fact, if we pull up the Wi-Fi Interactive behind me, we can see the Dow is exactly unchanged, just a little bit in the red right now. Let's check out the S&P 500. You can see here was the decision time, 2 p.m., barely movement there, although you can see already tacking on gains. And when you take a look at the two-day totals, a very impressive 3%. So the election really carrying things so far. There's going to be a lot of discussion and concentration and focus on the on Jay Powell's press conference, but that remains. And we just haven't seen a lot of price action, a lot of movement in the markets in this in-between period from 2 p.m. to 2:30 between the announcement time and also the podium time. So let's take a look at the sector action behind me. Tech was leading before this and financials were lagging. That really hasn't changed that much. We can see if we pull up a chart of XLK right near the highs of the day there. Financials, which were just soaring yesterday, those are at the lows of the day. But here's the two-day price action. You can see still holding on to gains of 4.6%. You take a look inside the Nasdaq. This was already very green before the report. But let's skip over to the bond market right now. I did not see a lot of movement there. Here's a 10-year U.S. Treasury note futures, and you can see they were just barely ticking down. That means that yields are going up slightly after coming down. But the big movement was yesterday. Here's the two-day look at the bond market, and you can see right there, still looking at gains of 0.5% in the T-note futures. I can also take a look at gold. We saw gold on the move. Pretty big down day yesterday. Not too much movement off the report, so everybody just waiting for Powell to take that lectern, guys.
Exactly, Jared. Thank you so much. Now let's bring in our panel of experts. Joining us is Emily Rowland, John Hancock Investment Management and Co-Chief Investment Strategist, RJ Gallo, Federated Hermes Senior Portfolio Manager, and Gregory Dacco, EY Chief Economist here in studio with us. Thank you all for being here. Greg, I want to start with you here in the studio. When you look at this statement, I mean, as we talked about, not much surprise in the actual cut. What stands out to you from the statement?
I think the statement reads a little bit more hawkish. There were a couple of interesting developments in the statement. The removal of further progress, the removal of the confidence statement, gain further confidence that inflation is moving towards 2%, and the removal of the progress statement in terms of the balance of risks and inflation. Those are a bit more hawkish. Perhaps there is some positioning for an environment that may be a little bit more inflationary as we navigate into 25.
Set the table for a pause in December?
I don't think a pause in December, but perhaps a little bit more optionality when it comes to the direction of travel of monetary policy going forward. I still believe December is likely to be a meeting at which the Fed decides to cut by 25 basis points, but there is a lot of uncertainty regarding 2025, and perhaps this is opening the door to more optionality next year.
Emily, let's bring you in here as well. And of course, always great to see you, Emily. As a strategist, let me get your reaction. I don't see a ton of reaction in the markets right now. I mean, 25 was expected. Greg does make the point, maybe a bit more hawkish. They do say inflation remains somewhat elevated, but let me get your thoughts, Emily.
Yeah, not a lot of surprises. Of course, we were also expecting 25 basis points. And I agree with Greg that the statement was modestly more hawkish. And I think that was probably a smart move from the Fed. You know, what you've seen since the last cut is this historical backup in bond yields, almost 80 basis points higher since the Fed cut. That's very, very unusual. There's been a few factors that have led to it. One has been slightly better than expected economic growth. I wouldn't say it's great. I would say we've seen good economic growth. And of course, you've got this pricing in of the potential for more fiscal stimulus, extension potentially of tax cuts, all of those pro-cyclical policies coming into the price here. So it's almost like the bond market has been doing the Fed's job for them in a way, in terms of keeping the economy from seeing any type of significant downturn. And the Fed may want to use their words carefully here in order to remind us all that, they are seeing some cracks in the economy. They're seeing cracks in the labor market. Inflation's coming down, and that does warrant some cuts. And maybe we see a little bit of relief here in terms of that backup in bond yields.
Well, to Emily's point, RJ, with the yields remaining high and even moving higher here, does that also kind of work at cross purposes of what the Fed is trying to achieve? Does that make their job harder?
Well, I would agree that the tone of the statement, it does cut just a slight bit more hawkish than the predecessor statement. In terms of what bond yields have been doing lately, I view it clearly the economy has been resilient. It's not fading that much. The labor markets are relatively firm. The fact that yields have risen so much since the last Fed meeting tells you a couple of things. One, 50 basis point ease, which is a bit of a surprise last month, or back in September, excuse me, that actually helped to diminish even further the prospect of any recessionary risk in the very near term. And then secondly, the markets were reacting to the betting markets and the probabilities heading into the election that a stimulative red sweep was going to result, and that's probably what we're going to have. So does this work at cross purposes to the Fed? The Fed is working to secure a soft landing. If in fact fiscal policy resumes a rather stimulative footing, that also helps to secure a soft landing. So the Fed's amount of easing going forward should be a little bit less if in fact we get the kind of stimulative policies out of the Trump administration and a potentially Republican Congress.
Greg, I want to bring you back in here. On inflation, we know they say remains somewhat elevated, which was interesting because I was talking to Julie at the top of the show. I mean, headline inflation has fallen, of course. Core inflation maybe a bit more mixed, where we were at the beginning of the year, where we are now. Where do you see it headed from here?
I always talk about the fundamentals, right, when it comes to inflation. And what we see in the fundamentals is still disinflationary pressures. We're still in an environment where consumers are being price sensitive, where businesses have less pricing power, and where you're seeing strong productivity growth. We had strong productivity growth this morning as of the third quarter. So these are disinflationary dynamics that will continue to play out. I think it is still the case that inflation is slightly above the 2% target, but we're talking about a couple of decimals at most. PCE inflation is at 2.1%. Core PCE inflation is at 2.3 if you look at shorter term measures, 3 months, 6 month annualized.
Can I ask you, though, Greg, are there upside risks that you see to that?
Yeah, there's certainly upside risk. I think both cyclical and structural upside risk to inflation. Cyclical, we can talk about the potential for more tariffs. We can talk about the potential for reduced immigration, pressuring labor costs. But also on the structural front, there are also questions in terms of an aging population, putting more pressure on government spending and being inflationary. More structural pressure coming from the de-risking of the global economy and building resilience. More pressure also coming from an environment where you're seeing decarbonization of economies around the world. These are structural pressures that likely will put some upward pressure in a context that is geopolitically extremely sensitive. We should not forget the wars that are still happening around the world that could pressure oil prices, for instance.
Wow, a lot to. I don't know if you expected so many upside risks from the answer to that question.
I always expect a full answer from Greg.
Of course.
You know that, yeah.
Emily, so let's talk to you about some of those upside risks and whether any of this is feeding through to your strategy. I know that you're sort of in the economy is okay camp, but how are you thinking about those risks? And then how are you positioning around some of that?
Well, I agree that all those risks are there, but in a way, there's like a self-limiting factor here. So if you think about interest rates going up, that's going to limit or that's going to make borrowing costs more prohibitive, and that's going to push mortgage rates up. If you start to see mortgage rates creeping up to 8%, we think that that's going to cause a significant challenge to the economy. So I think there becomes a level in which actually higher rates, if there is some type of inflationary, sort of reflexive response here, they could be self-limiting in a way, which is a key reason that we continue to see value in the income that's available in bonds. We looked, for example, at the last Trump presidency. It's really nice that we have this example of sort of what already happened. And of course, it's not perfect by any way, shape, or form. But what we looked at was bond yields. And we saw a very similar backup in yields. Of course, it happened right after the election because the result was more of a surprise to markets. But bond yields moved up 80 basis points right after the election and then moved sideways for a year. Then they moved up again based on pro-cyclical policies, but they ended 2019 basically exactly where they started. During the very beginning of the first Trump administration. So again, while not every playbook is going to be perfect, it's certainly something that we should consider here as it relates to, remember, we still have to deal with the lagged impact of all the tightening that the Fed did over the course of a couple of years. And we do think that that puts some modest downward pressure on economic growth, which means the value of the income available in bonds is really attractive.
RJ, bring you back in here. I want to touch on that same point with you. Look at yields. I'm just looking at the 10-year RJ, 4.36 here. What, in your opinion, has been driving that RJ? And I'm curious where you think that heads from here.
Well, Emily and I touched on this a moment ago. The economy has proven to be pretty resilient. I think that it's pretty clear that we probably have had the soft landing, and the Fed's efforts today, back in September, lowering rates, they're all meant to secure that soft landing. So yields have risen, even though the Fed eased quite a bit, because the prospect of recession has faded. And that's number one. Number two, the prospective fiscal policy going forward is apt to be stimulative. Throw in the risk of an aggressive use of tariffs, and that's potentially inflationary. The bond market is reacting very rationally to what happened at the ballot box here in the United States. I think as you look forward, yes, yields are rising for fiscal and monetary policy reasons. Yes, there is a lot of uncertainty. I think one thing that's a little different this time versus Trump 1.0, the amount of debt outstanding, both in terms of dollars or relative to GDP, is much greater. The legacy of the pandemic in nearly all developed markets is much more sovereign debt. And we're heading into a period now where the incoming president and likely incoming Congress are going to enact policies to further stimulate an economy that's growing above trend. The inflation concern is greater. Rising inflation concerns with a lot of debt makes the bond market a little bit more dicey of a place to be. Interest rate volatility is apt to remain somewhat elevated. And I'm a little concerned that the fiscal picture is going to manifest itself in terms of sort of a credit premium being built into the longer end of the curve. And that should lead to, all else equal, higher yields if the economy continues to grow.
Emily, I want to give you a chance to respond to that, since it's a little bit different than the framework you were talking about.
Yeah, I think that is the number one risk. And I was nodding my head during that conversation for sure. And it's a key reason that we have an extended duration, really beyond the intermediate part of the curve. I think this is a really challenging environment in fixed income where you've got to pick your sweet spot. The risk, of course, is around the debt and more supply coming online, which would push yields up. But then you look to what are your options? You look to the credit market. High yield bond spreads this morning were 265 basis points over treasuries. That is of the tightest over the last 15 years. So yes, the economy is doing well, but there is a risk that credit is priced for perfection here, particularly down in quality. So we really want to target the intermediate part of the curve. We're neutral on duration. We're looking at things like single A investment grade corporate bonds, mortgage-backed securities, treasuries as a way to really, take advantage of the value that's been unlocked here without going over our skis and taking risk.
Greg, is your base case still soft landing?
Yeah, I think we are in a soft landing. We've been in a soft landing for a while now. The question is whether we can maintain that soft landing. And I think there are, different perspectives as to what the outlook could be in 2025. But the reality is that a lot of the potential policy shifts, whether it's tax policy shifts, trade policy shifts, regulatory could happen earlier, immigration as well could happen earlier, but trade and tax, those are late 25, early 26 stories. So in terms of the effect on the real economy, we have to be a little bit careful about promising these short-term gains in terms of real economic activity. The economy going into the next 3 months is still going to be evolving on the momentum that we've seen so far. And so the guidance in terms of monetary policy needs to reflect that. We need to have more of a perspective as to how the economy will evolve over the next 3 months and recalibrate monetary policy to that environment rather than to a potential hypothetical environment that may occur in late 25 or early 26. I think that's how Powell is going to approach the press conference, talking about how he navigates in a dark room full of objects to take a picture that he took a few years ago when COVID was hitting.
Greg, you talked about some of the upside risks. What is the sort of ideal scenario? What would be the best scenario for the economy into next year, both from an economic perspective and from the Fed's perspective?
Well, the secret recipe to a soft landing is strong productivity growth. And that is the key reason
and we got new productivity numbers today.
Exactly. Why the U.S. economy has been outperforming all of its peers around the world. We're in an environment where we're seeing pro-cyclical productivity growth around 2.5%. That is something that we have not seen since the early 2000s. And it's not right now tech-driven. Tech is certainly part of the story, but it's businesses doing their best to offset the high cost of talent by increasing efficiency at their own companies. So it's a bottom-up driven type of productivity growth momentum that is very encouraging because it's disinflationary and addresses some of the supply chain pressures and supply pressures that we've seen across the economy for the better part of the last few years.
Emily, before we let you go, I just want your take generally on the stock market, the reaction response. Yeah. Emily, we've seen this election, the explosion yesterday. Emily, is that investors saying, listen, okay, we've got certainty on the election. I've got a decent economy, decent earnings growth. I got good seasonals behind me. I mean, does this added fuel of possible tax cuts and deregulation, is that actually a factor, or it's actually 24 hours and that doesn't factor in?
Yeah, so I think it's all of those things. I think, markets certainly are excited about the prospects for lower corporate tax rates, whether that happens or not. It was certainly accretive to earnings growth when we saw the Tax Cuts and Jobs Act back in 2017. But, I would just build on what Greg was talking about and the ability of U.S. companies to really see the best earnings growth. We have to remember over time that stock prices follow profits. And that's a key reason that we've been overweight U.S. equities here. We continue to find opportunities in high quality stocks. We like mid caps. That's going to be our way of sort of playing these pro-cyclical policies, this investment in the United States. We're seeing a manufacturing renaissance in the U.S. The industrial sector is one of our favorite areas to play that. But again, looking for opportunities where there is earnings growth, and just it's challenging because the market's really expensive right now. We're at 27 times trailing earnings. That's about as expensive as the markets have been over the last 20 years. So we've got to find those areas where we can see earnings continue to drive those stocks and be really picky here.
Guys, really fun, insightful conversation. Emily Rowland of John Hancock, RJ Gallo of Federated Hermes, Greg Dacco of EY. Thank you all very much. Greg is actually going to be back after the press conference. Thanks a lot. Coming up, while we're waiting to hear from Federal Reserve Chair Jay Powell, we're going to speak to a former Fed president to get more reaction following the Fed's latest rate cut decision. Stick around. We've got much more Yahoo Finance special coverage still to come.
The Federal Reserve have cut interest rates again, this time by 25 basis points, marking the second rate cut in 7 weeks. For more, let's welcome in now Esther George, former president and CEO of the Federal Reserve Bank of Kansas City. Esther, it's good to see you. So the Fed does cut by a quarter point as expected. Esther, we did have some guests on the panel, Esther, saying that they thought it tilted perhaps a bit more hawkish in the statement. But let's get your reaction, your response, Esther.
Yeah, so the 25 basis points certainly was expected. Very little change in the statement from my perspective. And I think if any lean hawkish, it simply is in the context of an FOMC that sees uncertainty ahead, and they're going to keep their options open.
Do you think that there is more uncertainty today than there was on Monday? In other words, do you think, is the uncertainty just what we're seeing in the economy? Is the uncertainty more of the fiscal variety? How are you sort of judging those risks?
So I think it is really a combination of things that makes now an uncertain time. Obviously, this is a committee that is trying to judge where an equilibrium is in our economy in terms of how many rate cuts, how fast they need to go. They see and have seen for some time fiscal issues ahead. And certainly when you have a new administration coming in, a new Congress, they'll be thinking and watching carefully how any new policies may come to bear on the economy.
And Esther, what do you think the rate path looks like from here, December, January, you know, and is it more cuts? Is it a pause? If it was a pause, what would that depend on?
Well, the pause could come if there was any unexpected data that would surprise, but my guess is they will be pretty steady in thinking about what was already in play. It's too soon, I think, for them to know what changes lie ahead for 2025. So I think you could see another rate cut in December. And then I think the path is really up for grabs, depending on how they hear the potential for policy. We're watching the 10-year, which continues to show some upward pressure. And I think this is a committee that understands they're not yet achieving their goals. They still have inflation over target. They're happy with the labor market where it is, but they have more work to do.
I'm glad you brought up the 10-year because we have been watching it and talking about it a lot, the fact that it is moving upward while we are seeing rates go down. And a lot of folks talking about that that's reflective of the optimism about economic growth, some talk also about fiscal policy and that effect. As someone who was inside that room, how much is the committee watching yields and watching the bond market?
Well, you watch them very carefully, and of course they can move around, but what you're looking for are indications of how tight or how easy financial conditions are and what expectations lie ahead for this committee as they set their forecast. You know, we'll see in December updated individual forecasts that will come out in the dot plot and have a better sense of how this committee is thinking about the path ahead. So I think that's going to be important here because they are watching financial conditions very carefully.
Can I ask you, Esther, what is the right level of rates? What is the final stop for the Fed here? Is it, is it around 4? Is it 3, Esther, lower?
Well, I guess we all are looking for the answer to that, as are members of that committee. And as Chairman Powell has said on a number of occasions, we'll know it when we see it. We have to sort of see how the economy settles out. It's why I worry a little bit about focusing too much on soft landing, because that, in fact, is not the objective for the Fed. The Fed has very clear mandate around its inflation target and employment. So it's really wrestling with those variables to judge when they think this economy has reached an equilibrium. So is it as high as today? Not likely. Will it be higher than we saw over the past decade? I suspect it will be.
Well, I do want to ask you one political question about something that has been floated either by President-elect Trump or people within his campaign, which is he said he would not fire Jay Powell as head of the Federal Reserve. But there has been this idea that perhaps before the chair's term is up in 2026, that a new Fed chair might be announced or nominated well in advance. What do you think that would do? I mean, we have seen things like that where we've seen the independence of the Fed sort of ebb and flow throughout the years. What effect do you think that would have on policymakers' ability to set rates?
So I think there's always some level of speculation about who the candidates could be for a position like that when you can see that a term is coming up. On the other hand, I think Congress is going to be very focused on understanding it could be unsettling to markets. It could be unnecessary in many respects to have that kind of an issue come forward. So the Fed chair is secure in their seat until their term is up. That's part of the independence of this institution. And I think that's where certainly the current members will be focused. And I think Congress is going to be sensitive to this issue as well.
You know, it's interesting, Esther, the Fed chair is secure in that seat. I just wonder, let's say the Fed decides, early next year, you know what, we're looking at the data and a pause makes sense. You could see a situation, Esther, in which that decision wouldn't go over that well with our president-elect. I'm just wondering how you think that dynamic could play out.
Well, we know that when politicians don't like what the Fed is doing, they often are very vocal about that. And we've seen that time and time again in the past. It's really the job of the Fed to stay focused on its mandate, which is given to it by the Congress. And so it will require the Fed to stand up to pressures that it may receive, whether they're simply rhetoric, or they're more, I think, direct threats. But I think the Fed is well prepared and able to focus on where its mandate lands, and that is securing its mandate on behalf of the American public. And that will be an important aspect of how they set monetary policy for the country.
Esther, thank you so much for your time. Really appreciate your perspective. Esther George is former president and CEO of the Federal Reserve Bank of Kansas City. Thank you.
Thank you.
Well, we are now awaiting Fed Chair Jay Powell to begin that press conference that we've been talking about. We have seen that stocks have turned a little mixed. I mean, the Dow is very slightly higher before. Now it is very slightly lower. The S&P and the Nasdaq haven't moved much. We've not seen really markets overall move much. As Jared Blickery pointed out earlier, we're really waiting for the Fed Chair's comments because there wasn't anything that was really that significantly different from expectations with the statement.
Yeah, I mean, what do you hear from Jay Powell, if anything, about Fed guidance? Does he hint about December? Does he even, does he suggest a pause or at least kind of tell you what variables would go into that? Does he sidestep it entirely? I thought that was a really interesting final point from Esther George, by the way, because there is a new political dimension here. We have President-elect Trump. He's going to share his opinions, we know that. And we sort of asked, like Esther George said, listen, the Fed's job, regardless of that dynamic, you stay focused on the mandate. Yes. You got to be tough enough to stay up to the pressure.
All right, here is Jay Powell about to give a statement and answer some questions from the press.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong overall and has made significant progress toward our goals over the past 2 years. The labor market has cooled from its formerly overheated state and remains solid. Inflation has eased substantially from a peak of 7% to 2.1% as of September. We are committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. Today, the FOMC decided to take another step in reducing the degree of policy restraint by lowering our policy interest rate by 1/4 percentage point. We continue to be confident that with an appropriate recalibration of our policy stance, strength in the economy and the labor market can be maintained, with inflation moving sustainably down to 2%. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.8% in the third quarter, about the same pace as in the second quarter. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has strengthened. In contrast, activity in the housing sector has been weak. Overall, improving supply conditions have supported the strong performance of the U.S. economy over the past year. In the labor market, conditions remain solid. Payroll job gains have slowed from earlier in the year, averaging 104,000 per month over the past 3 months. This figure would have been somewhat higher were it not for the effects of labor strikes and hurricanes on employment in October. Regarding the hurricanes, let me extend our sympathies to all the families, businesses, and communities who have been harmed by these devastating storms. The unemployment rate is notably higher than it was a year ago, but it has edged down over the past 3 months and remains low at 4.1% in October. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market are now less tight than just before the pandemic in 2019. The labor market is not a source of significant inflationary pressures. Inflation has eased significantly over the past 2 years. Total PCE prices rose 2.1% over the 12 months ending in September, excluding the volatile food and energy categories. Core PCE prices rose 2.7%. Overall, inflation has moved much closer to our 2% longer run goal, but core inflation remains somewhat elevated. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. We see the risks to achieving our employment and inflation goals as being roughly in balance, and we're attentive to the risks to both sides of our mandate. At today's meeting, the committee decided to lower the target range for the federal funds rate by a 1/4 percentage point to 4.5% to 4.75%. This further recalibration of our policy stance will help maintain the strength of the economy and the labor market, and will continue to enable further progress on inflation as we move toward a more neutral stance over time. We know that reducing policy restraint too quickly could hinder progress on inflation. At the same time, reducing policy restraint too slowly could unduly weaken economic activity and employment. In considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. We are not on any preset course. We will continue to make our decisions meeting by meeting. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains strong and inflation is not sustainably moving toward 2%, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly, or inflation were to fall more quickly than anticipated, we can move more quickly. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our discussion.
Thank you. Given the expectation that the election outcome will produce policies that would meaningfully impact the U.S. economy next year, how is the committee taking these proposals into account for upcoming decisions, including potentially the next one in December? And can you give us any more sense of how proactive or reactive the Fed is prepared to be to changes in economic policies with the next administration?
Sure. So let me say that in the near term, the election will have no effects on our policy decisions. As you know, many things affect the economy, and anyone who writes down forecasts in their job will tell you that the economy is quite difficult to forecast looking out past the very near term. Here, we don't know what the timing and substance of any policy changes will be. We therefore don't know what the effects on the economy would be, specifically whether and to what extent those policies would matter for the achievement of our goal variables, maximum employment and price stability. We don't guess, we don't speculate, and we don't assume. Now, just in principle, it's possible that any administration's policies or policies put in place by Congress could have economic effects that over time that would matter for our pursuit of our dual mandate goals. So we, along with countless other factors, forecasts of those economic effects would be included in our models of the economy and would be taken into account through that channel.
Nick.
Chair Powell, Nick Timros from the Wall Street Journal. Roughly 1 year ago, when the 10-year Treasury was flirting with 5% and 30-year mortgage rates were near 8%, you noted how higher borrowing costs, if they were sustained, could weigh on economic activity. Given that you've said you believe policy is restrictive and the Fed is now dialing back that restriction, are the growth risks presented by higher U.S. Treasury yields today any different from those you identified 1 year ago when inflation was still meaningfully above your target?
So I would just say this: we've watched the run-up in bond rates, and it's nowhere near where it was, of course, a year ago. I guess the long bond rates are well below that level. So we're watching that. Things have been moving around, and we'll see where they settle. I think it's too early to really say where they settle. Ultimately, I'm sure we've all read these decompositions of what, and I certainly have, but it's not really our job to provide our specific decomposition. I will say, though, that it appears that the moves are not principally about higher inflation expectations. They're really about a sense of more likelihood of stronger growth and perhaps less in the way of downside risks. So that's what they're about. We do take financial conditions into account if they're persistent and if they're material. Then we'll certainly take them into account in our policy. But I would say we're not at that stage right now. It's just something that we're watching. And again, these things don't really have mainly to do with Fed policy, but to do with other factors in the economy.
If I could follow up, is the September SEP, are those rate projections still valid? Do they still seem relevant given where we are now? You get halfway through the cycle between the last set and the next set. I wouldn't want to comment one way or the other. Let's talk about the data we've gotten since the last meeting. So, in the main, the economic activity data have been stronger than expected. The NIPA revision was stronger. Certainly, the September employment report was stronger. The October report not stronger. Retail sales stronger. So overall, though, I think you take away a sense of some of the downside risks to economic activity having been diminished with the NIPA revisions in particular, and so overall feeling good about economic activity. So I think we would factor that in. At the same time, we got one inflation report which wasn't terrible, but it was a little higher than expected. So I think really the question is December, and by December we'll have more data. I guess one more employment report, two more inflation reports, and lots of other data, and we'll make a decision as we get to December.
Gina Smilik from the New York Times. Thanks for taking our questions, Chair Powell. When it comes to December, what will you be looking at specifically as you try to make that decision? And then as of the Fed's economic projections in September, you had written down 4 quarter-point interest rate cuts in 2025. Do you still think that those are likely? Is that sort of the baseline outlook at this point, or has that shifted? And if it shifted at all, can you give a little bit of detail as to why?
I can't. We don't fill out an SEP, and I can't characterize one that wasn't filled out today. So I can't really speak for kind of exactly where the committee is. I will just say for December we're going to be, again, at every meeting we're going to be looking at the incoming data and how that affects the outlook. As you know, we're in the process of recalibrating from a fairly restrictive level at 5.33%. After today's move, we're down 75 basis points. And we're asking ourselves, is that where we need to be? That we're trying to steer between the risk of moving too quickly and perhaps undermining our progress on inflation, or moving too slowly and allowing the labor market to weaken too much. We're trying to be on a middle path where we can maintain the strength in the labor market while also enabling further progress on inflation. We think that's where we are, but that's the question we're going to be asking in September.
and in other meetings. And again, I can't really update you on the committee's thinking because we don't fill out an SEP at this meeting.
Yeah, totally appreciate that. I guess when it comes to your own thinking, do you think that a full percentage point of rate cuts in 2025 is a reasonable outlook?
Again, I'm going to wait. We're going to wait and see how things come in December. I mean, it's just. I would put it this way: we're on a path to a more neutral stance, and that's very much what we're on. That has not changed at all since September, we're just going to have to see where the data lead us. We have a whole 6 weeks of data to look at to make that decision in December. Obviously, I'm not ruling it out or in, but I would say I would say that again, we didn't update the SEP, so I'm not going to characterize where the committee would be.
Howard.
Thanks, Howard Schneider with Reuters. I wondered if you could please elaborate, explain a little bit the two changes in the language of the statement here. In the first paragraph, when you say inflation has made progress, dropping the word further progress, and in the second paragraph, dropping the sentence that the committee had gained greater confidence that inflation was progressing towards its 2% goal. Is there any policy substance behind either of those changes in language? Is it meant to open the door to a December pause? Is it meant to communicate anything about the stickiness of core inflation the last 3 months?
Not really, no. So let me tell you what we were thinking. So the test of gaining further confidence was our test for the first rate cut, right? And so we met that test in September, and therefore we take that test out. If you leave it in, then it's new forward guidance. It's brand new forward guidance. What do you mean by it? Are you requiring yet further? We have to say yes or no at every meeting whether we've made further progress. The point is we have gained confidence that we're on a sustainable path down to 2%. So that I would tell you is what that's really all about. It's not meant to send a signal. Neither of those is meant to send a further signal. And saying further progress, it becomes a test. We don't want to be. We don't think it's a good time to be doing a lot of forward guidance. There's a fair amount of uncertainty in that. In what I've said, the path that we're on, we do know where the destination is, but we don't know the right pace, and we don't know exactly where the destination is. So the point is to find the right pace and the right destination as we go. And I think there's a fair amount of uncertainty about that. And you don't want to tie yourself up with guidance. You want to be able to make sensible decisions as you go.
Steve Leisman, CNBC. Mr. Chairman, you talked about higher rates, perhaps from an expectation of higher growth. You didn't talk about it in terms of expectations of higher deficits. Is that something you think might be behind the recent rise in interest rates, and are rising deficits a concern to you?
So we don't comment on fiscal policy, and again, I don't have a lot more to say on what's driving bond yields. In terms of policy changes, though, let me give you a sense of how this works in the ordinary case. Let's say Congress is considering a rewrite of the tax laws. Doesn't matter what's in the content. So we would follow that. At a certain point, we'd think we see the outline, so we'd start to model it. And then we'd wait, and then at a certain point, the staff would brief the FOMC and say, these are the likely effects. There's lots and lots of literature on the effects of tax policy changes on various parts of the economy. So we'd try to get smart on that, and then the law actually passes. And you'd start to put it. You'd probably run an alternative simulation before that happens, just to keep people trying to understand it. Then when it actually passes, it goes into the model, along with a million other things. So, we have a very large economy. Many things are affecting it at any given time, and a law change of some kind would go in there, but it would go in. But it would, it's a process that takes some time. Clearly, the legislative process takes a lot of time. And of course, the real question is not the effect of that law. It's all of the policy changes that are happening. What's the net effect? And the overall effect on the economy at any given time. So I think that's a process that takes a lot of time and that we go through all the time with every administration. constantly, and this will be no different. But right now there's nothing to model right now. It's such an early stage. We don't know what the policies are, and once we know what they are, we won't have a sense of when they'll be implemented or all those sorts of things. So I think I would just say we're not doing that now, and all that will take time, and it will be very much regular order when we do that.
If I could just follow up on Nick's question. Are the current rates something you feel like you need to lean against in that they go against the direction of policy by adding restriction to the economy, or do you just take them as a given and perhaps a signal that you should do less?
Look, I just think the first question is how long will they be sustained? If you remember the 5% 10-year, people were drawing massively important conclusions only to find, 3 weeks later the 10-year was 50 basis points lower. So, it's material changes in financial conditions that last, that are persistent, that really matter. And we don't know that about these. What we've seen so far, we're watching it, we're reading, we're doing the decompositions and reading others, but right now it's not a major factor in how we're thinking about things.
Chris.
Thank you, Chris Rugaber at Associated Press. You mentioned the positive economic data that we've seen since the September meeting, including the revisions to things like savings, higher GDP growth. We saw a stock market jump yesterday. That's renewed some of the questions about why do many cuts at all in this with this backdrop.
So you're right. As I mentioned and as you mentioned, the latest economic data have been strong, and that's of course a great thing and highly welcome. But of course, our mandate is maximum employment and price stability, and we think that even with today's cut, policy is still restrictive. We understand it's not possible to say precisely how restrictive, but we feel that it is still restrictive. And if you look at our goal variables, the labor market has cooled a great deal from its overheated state of 2 years ago and is now essentially in balance. It is continuing to cool, albeit at a modest rate. And we don't need further cooling, we don't think, to achieve our inflation mandate. So that's the labor market. Inflation has moved down a great deal from its highs of 2 years ago, and we judged, as I mentioned, that it's on a sustainable path back to 2%. So the job's not done on inflation. But if you look at those two things, we judged in September that it was appropriate to begin to recalibrate our policy stance to reflect this progress, and today's decision is really another step in that process. Overall, as I mentioned, we believe that with an appropriate recalibration of our policy stance, we can maintain strength in the labor market even as our policy stance enables further progress toward our inflation goal.
Great. And just to follow up, what might cause you to pause rate cuts in December? What kind of economic data would lead you to that path? Thank you.
So we haven't made any decision like that at all. But we're in the process, as I mentioned, of moving policy down, our stance down over time to more neutral level. And as a general matter, as we move ahead, we are prepared to adjust our assessments of the appropriate pace and destination as the outlook evolves. So, for example, if we were to see the labor market deteriorating, we'd be prepared to move more quickly. Alternatively, as we approach levels that are plausibly neutral, or close to neutral, it may turn out to be appropriate to slow the pace at which we're dialing back restriction. Again, haven't made any decisions about that, but that's certainly a possibility. If you can think of it as similar to what we do with asset runoff, with QT. So we reach a point where we slow the pace, much like an airplane reaching the airport slows down. And so we're thinking about it that way, but it's something that we're just beginning to think about.
Edward.
Thanks, Chair Powell. So with the noise in the jobs reports that we've seen, and you look at the Fed's favorite inflation, PCE inflation, overall it's 2.1%, very close to the Fed's target, but core inflation is 2.7%, and it's been that way since July. So why doesn't this data give fuel to a rate pause for this meeting?
Well, so I think if you look at the 3 and 6 month, you're quoting the 12-month. So yes, we look at all of them, right? But if you look at 3 and 6 month core PCE, you'll see they're around 2.3%. So we look at all of them, and we also look at 12 as well.
But what it's telling us is that we really have made significant progress, and we expect there to be bumps. For example, the last 3 months of last year, the core PCE readings were very, very low, probably unsustainably low. So that's why forecasts generally see a couple of upticks toward the end of the year. On the other hand, the January reading certainly looks like an example of residual seasonality, so that we saw last year. So when that falls out of the 12-month calculation in February, we should see a thing down. So it'll literally be a bump up and then down. We understand that. Overall, you see the progress on inflation, and you also look at the economy and you say, what is the inflation story now? Where's it coming from? So I point to a couple of things. One is the non-housing services and goods, which together make up 80% of the core PCE index, are back to the levels they were at the last time we had sustained 2% inflation, which happens to be in the early 2000s for a period of 5, 6, 7 years. So they're back to that level. What's not is housing services. So let's talk about housing services. Housing services is higher. What's going on there is, market rents, newly signed leases are experiencing very low inflation. And what's happening is older, leases that are turning over are taking several years to catch up to where market leases are, market rent leases are. So that's just a catch-up problem. It's not really reflecting current inflationary pressures. It's reflecting past inflationary pressures. So that's one thing. The other thing is, I'd say look at the labor market, not a source of inflationary pressures. Where's it coming from? It's not a very tight economy. What is the story about inflation? You see that catch-up inflation also in insurance and several other areas. So you're seeing, we're not declaring victory, obviously, but we feel like the story is very consistent with inflation continuing to come down on a bumpy path over the next couple of years and settling around 2%. That story is intact, and it won't be one or two really good data months or bad data months aren't going to really change the pattern at this point now that we're this far into the process.
So you're quickly trying to get to that neutral rate that you see, or do you foresee that you have some time to get there?
Nothing in the economic data suggests that the committee has any need to be in a hurry to get there. We are seeing strong economic activity. We are seeing ongoing strength in the labor market. We're watching that carefully, but we do see maintaining strength there. And so we think that the right way to find neutral, if you will, is carefully, patiently. Again, that's not meant to have a specific meaning, other than to the extent the economy remains strong, we have the ability to take advantage of that as we try to navigate that middle path between the two risks.
Craig.
Hi, Chair Powell. Craig Torres from Bloomberg. Two questions today. Did you learn anything about what Americans think about the economy from the election results? First question. Second question. I want to talk about some labor market indicators, and I do so with great respect for your attentiveness to the maximum employment side of the mandate, Chair Powell. So the unemployment rate has been at 4% or higher for 6 months. One of the broadest measures of unemployment is up about 0.5 point from a year ago. Compensation gains are sliding back. The quits rate, a signal of labor market dynamism, has been heading down to that bad neighborhood of the 20 teens. So you have put a marker at Jackson Hole saying any further cooling is unwelcome. It is cooling generally a little bit further. So at what point do we reach what you would describe as a shortfall from maximum employment? Thank you.
Sure. So on your first question, I'm not going to talk about anything that relates directly or indirectly to the election. On the second one, this is the great question, and it's the one we think about all the time. So I'll just say a couple things. There's nothing really surprising here. What we know is that the unemployment rate is low. We also know that it's moved up significantly from a year or so ago. So we've seen a big change upward in unemployment. Sometimes that has meant bad things. So far, it doesn't appear to be. It appears that I wouldn't say that the labor market has fully stabilized, because I do think it's continuing to very gradually cool. but it seems to be in a good place, and our policy, of course, is designed to keep it in that good place, to maintain the strength in the labor market, while also enabling further progress on inflation. You know, you mentioned a bunch of indicators, and you're right. You know, the openings to unemployment rate is back to a normal level. I would characterize it more broadly as normalizing. You mentioned wages. Wages are still running just a bit above where they would need to be consistent with 2% inflation, unless productivity is going to remain at this high level. If we see productivity, you know, more sustainably at these high levels, then that would sustain higher wage gains. So I would say, in fact, you can say it the other way, that wage increases are now consistent with 2% inflation given current productivity readings. But of course, the lore on productivity readings is whenever you see high readings, you should assume they're going to revert pretty quickly to the longer-term trend. That has always been the case for 50 years. But you know, it may be that we're now 5 years. If you look at the NIPA revisions that came out a month ago, we're 5 years into a nice set of productivity readings, which are sustained and very healthy. But overall, it's a good labor market. We could talk about 20 different data series. We'll be looking at all of them, of course. You know, we don't want the labor market to soften much from here. We don't think we need that to happen to get inflation back to 2%.
Victoria. Hi, Victoria Guido with Politico. Some of the president-elect's advisors have suggested that you should resign. If he asked you to leave, would you go?
No.
Can you follow up on, do you think that legally you're not required to leave?
No.
Mike?
Michael McKee from Bloomberg Radio and Television. You talk a lot about what the data are telling you and how you are dependent on the data, but in terms of forward-looking assessments of the economy, what are you hearing from CEOs or other officials around the country? What did you hear today from the regional bank presidents about what companies and consumers think about where the economy is going from here rather than looking backwards? And does that match up with what your forecasts have been and what you think the appropriate policy path should be?
So it's hard to characterize a really interesting set of discussions we had, and of course you'll see them in the minutes in 3 weeks. But I would say this: I think the comments from our Reserve Bank colleagues and from the CEOs that they talk to are pretty constructive on the economy right now. Pretty constructive, feeling that the labor market is back to normal, to the point where it's no longer that much a discussion topic in their worlds, whereas 2 years ago it was all they were talking about. So they feel like the labor market's in balance. People feel good about where the economy is. Demand is obviously pretty strong, and you're seeing 2.8% growth in the third quarter estimated. Maybe the year's 2.5%. This is a strong economy. It's actually remarkable how well the U.S. economy has been performing with strong growth, a strong labor market, inflation coming down. We're really performing better than any of our global peers, and I think that is reflected in what you hear from what I hear people hear from CEOs. I don't get to talk to a lot of CEOs in my job, but I hear what others summarize from those, and of course I hear the Reserve Bank presidents do a lot of that, and it's pretty constructive overall. Now, that's not to say there are areas of caution and things like that, but ultimately, overall, pretty positive.
Well, to follow up the areas of caution, if there were black clouds on the horizon that you identified as something you're watching, what would they be?
I think it's things like clearly geopolitical risks around the world are elevated, and just as clearly they've had relatively little effect on the U.S. economy. Now, that can change through the price of oil or otherwise, but people talk about those as something that's on the horizon all the time. But ultimately, if you look at the U.S. economy, its performance has been very good, and that's what we hear from business people, and expectation that will continue. If anything, people feel next year, I've heard this from several people, that next year could even be stronger than this year.
Andrew.
Hi, it's Andrew Ackerman with the Washington Post. I just wanted to follow up on the discussion earlier on fiscal policy. Your predecessors, Greenspan and Volcker, spoke up loudly when they thought large budget deficits endangered economic or financial stability. Will you do that too? And right now we're in a period of full employment. We have large budget deficits and debt at historic highs that are rising. Is that something you'd speak out against?
So, I have said many times, no more, no less than what the predecessors you mentioned have said. And what that is that the U.S. federal government's fiscal policy is on an unsustainable path. The level of our debt relative to the economy is not unsustainable. The path is unsustainable. And we see that you've got a very large deficit you're at full employment, and that's expected to continue. So it's important that that to be dealt with. It is ultimately a threat to the economy. Now, I can say that. I don't have oversight. We don't have oversight over fiscal policy. I've said it on many occasions, just said it again.
Okay, thank you. I guess the other question is, to follow up on Victoria's question, do you believe the president has the power to fire or demote you, and has the Fed determined the legality of a president demoting at will any of the other governors with leadership positions?
Not permitted under the law.
Not what?
Not permitted under the law.
Thank you.
Courtney.
Courtney Brown from Axios. In response to Howard's question, you said it wasn't an ideal time to give forward guidance because of the economic uncertainties. Can you lay out what some of those uncertainties are and whether or not it includes some of the proposals that the president-elect has put out on the campaign trail, tariffs, for instance?
No, I was not referring to the new administration's policies at all, nor will I today. So what I'm just saying is, as we look ahead, we know, and I mentioned this in my statement, that the risks are two-sided. I guess I should start by saying that we think that the economy and we think our policy are both in a very good place, And but as you look forward, you say, what are the risks? And one risk is that we would move too quickly and find ourselves having moved too quickly, and inflation comes back, and we lost our chance to get inflation back to 2%. So we have to avoid that risk, and to avoid that risk, that means you want to move carefully. The other risk is that we move too slowly, and that we allow the labor market to weaken too much and do unnecessary damage to the labor market and to people's working lives. That says don't get behind the curve. So these two things are the two risks that we have to manage, and so we're in the middle there. We try to be in the middle and deal with manage both of those. Again, the idea is to support the strength we have in the labor market and in the economy, but also with somewhat less restrictive but still restrictive policy, enable further progress toward our 2% inflation goal. This is a thing where we're meeting by meeting. We're going to be making our assessment of what the right path is. It's not as important. The precise timing of these things is not as important as the overall arc of them. And the arc of them is to move from where we are now to a sense of a more neutral policy. We don't know exactly where that is. We only know it by its works. We're pretty sure it's below where we are now. But as we move further, there will be more uncertainty about where that is, and we're going to move carefully as this goes on, so that we can increase the chances that we will get it right.
Simon.
Thank you, Chair Powell. Simon Rabinovich with The Economist. I know you don't want to share your decomposition of bond yields, but if you look at the break-evens, it is clear that longer-term inflation expectations do seem to have risen, up at about 2.5%, for example, on the 5-year. That's up half a point from when you cut in September. Do you have any concern at all that longer-term inflation expectations are de-anchoring, or put another way, are anchoring at a slightly higher level? Thanks.
So we would be concerned if we thought we saw longer-term inflation expectations anchoring at a higher level. That's not what we're seeing. We're still seeing, between surveys and market readings, broadly consistent with, I looked at the 5-year earlier today, and it's probably moved, but it's just not, it's kind of right where it's been, and also it's pretty close to consistent with 2% PCE inflation. So that's been a traditional one that we look at a lot. But overall, expectations seem to be, and really have throughout this, in a place that's consistent with 2% inflation. But you're right to say we watch that very carefully, and we will not allow inflation expectations to drift upward. But that's really why we reacted so sharply back in 2022, was to avoid that.
Kelly. Hi, Chair Powell. Kelly O'Grady, CBS News. We just talked about what you've heard from business leaders on the economy, but many average Americans are still not feeling the strength of the economy in their wallets. So what's your message to them on when they might expect relief?
So you're right that we say the economy is performing well, and it is, but we also know that people are still feeling the effects of high prices, for example. And the world went through a global inflation shock, and inflation went up everywhere, and it stays with you because the price level doesn't come back down. So what that takes is, it takes some years of real wage gains for people to feel better. And that's what we're trying to create, and I think we're well on the road to creating that. Inflation has come way down, the economy is still strong here, wages are moving up, but at a sustainable level. So it's just, I think what needs to happen is happening, and for the most part has happened, but it'll be some time before people, regain their confidence and feel that. And we don't tell people how to feel about the economy. We completely respect what they're feeling. Those feelings are true, they're accurate. We don't question them. We respect them.
And just a quick follow-up. President-elect Trump has been critical of your performance. Any concern about his influence on the Fed's independence?
I'm not going to get into any of the political things here today, but thank you.
Nancy.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. What is your plan if we start to see stagflation?
Well, so that's the whole plan is not to have stagflation, so we don't have to deal with it. So that is actually our plan. It's of course a very difficult thing because anything you do with interest rates will hurt one side or the other, either the inflation mandate or the employment mandate. I would just say that we've been able to see inflation come down a whole lot, much closer to our goal, without the kind of sharp increase in unemployment that has often accompanied programs of disinflation. So, knock on wood, we've gotten this far without seeing a real weakening in the labor market, and we believe we can complete the inflation task while also keeping the labor market strong, and that, of course, is exactly what we're trying to do.
Can you rule out an interest rate hike next year?
No, I wouldn't rule anything out or in that far away, but that's certainly not our plan. I mean, our baseline expectation is that we'll continue to move gradually down towards neutral, that the economy will continue to grow at a healthy clip, and that the labor market will remain strong. If you look at our that will not change from the September SEP. That is our baseline forecast, and short of some exogenous event, that will continue to be our forecast for the foreseeable future. So. But ultimately, we're not in a world where we can afford to rule things out a full year in advance. There's just too much uncertainty in what we do.
Go to Jean for the last question.
Hi, Chair Powell. Jean Young with MNI Market News. I wanted to go back to a comment that you had made about Americans being quite unhappy about the cumulative price level rises over the past few years, even though now inflation is back on a path to 2%. Would it be appropriate for the Fed to undershoot for a while on its inflation goal under the average inflation targeting regime so people have a chance to catch up?
No, that's not the way our framework works. We're aiming for inflation at 2%. We did not think it would be appropriate to to deliberately undershoot. And part of the problem there is that low inflation can be a problem too, in a way. But that's not part of our framework, and it's not something we're going to be looking at in our framework review. Thank you very much.
That was Federal Reserve Chair Jerome Powell speaking following the latest decision from the FOMC to cut rates by a quarter point. The main takeaway, or one of the main takeaways, he's not going anywhere. He was very firm on that point when asked if President-elect Trump were to ask him to step aside. Would he? No, he said very simply. And he also was asked whether President-elect Trump would have the ability to remove him. And he said, no, it is not permitted by the law, nor would a demotion of a Fed vice chair be permitted under the law. Now, of course, he said lots of stuff about inflation, about the labor market, but I think that is the main takeaway, the big headline.
Yeah, pretty simple, pretty direct, pretty clear from Jay Powell on that. The first question out of the gate, of course, was about politics on Trump's election win and the policy agenda and how he's thinking about whether that would, how that could impact the economy. I think we all knew that one was coming. And I think we knew how Jay Powell would respond, which is what he said, which is near term, the election has no impact on policy decisions. Went on to say, paraphrasing here, we don't know what the timing of these policies are, the substance of the policies are, so I can't actually tell you, he said, what of course, the impact would be.
Right. I just wanted to run through real quickly what we're seeing in the markets right now. For that, we can take a look at the Yahoo Finance Interactive, and we are not really seeing much change here. If you look at the intraday moves, there's the Dow. I mean, the Dow's kind of been all over the place, but it's been a tight range today. The S&P 500 ticking up very slightly to the highs of the session here, and we did actually see a little move upward when he was quite firm on the idea that he is not going anywhere. The Nasdaq has been the leader of the day. It's up by about 1.5% here. So we have seen that movement. We also have been watching bond yields that have been drifting lower. Now, these are a bit delayed, so take that with a grain of salt, but still, we've been seeing that fairly consistently, that decline in the 10-year yield throughout the day. And we've also been seeing commensurate declines in the U.S. dollar index, Josh.
Interesting how I got a couple questions there at the end, too, about how people are feeling about the economy, because he sounded broadly, I mean, constructive on what the data he's seeing, but he was asked a couple times, what do you sort of make of the polling, the surveys that we have out there, people not feeling so great about the economy, and Powell is saying, listen, he respects how people are feeling, it's real, they still feel the cumulative impact of higher prices, and he said it's going to, in his opinion, take a few years of real wage gains for people to regain that confidence.
Yeah, and I think, under his tenure, it has been very interesting to hear that sort of, that he has tried to be empathetic about the pain that normal Americans are feeling with increased prices. That has been a pretty consistent refrain from him.
Yep. All right, let's get more voices in here. So for more Fed reaction, let's welcome in now Kevin Gordon, Charles Schwab, Director and Senior Investment Strategist, and also back with us in studio is Gregory Dacko, EY Chief Economist. Greg is the resident economist on the panel here. Let me get your first takes. What did you make of what you heard from Jay Powell there?
Well, I think there were a few interesting remarks here. I think number one, there is increased optimism about the economy. There is still the sense that we're headed towards a soft landing. Powell was very clear to signal that there's no victory against inflation, but we are moving in the right direction. The second important takeaway is that he made sure to highlight the fact that the changes to the statement were not necessarily as hawkish as we initially thought. The removal of gaining greater confidence that the economy is moving towards 2% inflation and further progress towards inflation, those might have been seen as potentially hawkish. Powell made sure to say that this wasn't necessarily a sign of more hawkish policy, but instead a test in terms of the forward guidance. We don't need to see further progress. We're moving in the right direction, and we don't need to see any additional progress in accelerating disinflation.
And Kevin, is the market happy that Jay Powell is going to stay the course, that there don't seem to be, at least initially here, and that the message was, I'm here to stay until my term is up in May 2026.
Well, yeah, because I think, for the most part, and with all the flack that the Fed has gotten in this cycle, one thing that they've been really consistent on is being data dependent, whether we like it or not. I mean, I think Powell has done a good job of navigating a really tough backdrop over the past several years. Yes, you could, make the argument that they were late in raising rates, but they've already talked about that and they've already admitted to it. And I think that the best way to be an ex-post Fed where you're really looking, month to month based on the data coming in, is being transparent about the fact that, you really don't know, especially when you're so supply shock prone in this environment, which makes this so much different than any other period we've seen. And you add in the prospect of, more policy uncertainty for 2025, especially on the supply side, whether it's labor or whether it's tariff related. I think that really, probably hamstrings the Fed and makes their job a little bit tougher. It's way too, premature to look ahead a year from now and say where we're going to be from a tariff perspective or from a labor immigration policy perspective. But to your point about taking out the inflation statement regarding confidence of the statement itself, I think that is a way of this Fed at least preserving optionality for not only, maybe not December, but maybe for the full year of 2025, and just, again, admitting that the clarity is just not there in what it used to be maybe pre-COVID.
Greg, there was a question that was asked, and I want to get your take. They were talking about what we're seeing with yields, and the reporter asked, Jay Powell, is that because of expectations for stronger growth, or is it rising deficits that's causing it? I don't think Jay Powell wanted to weigh into that too heavily. It's like, but as an economist, how are you thinking about that?
Yeah, I don't think he necessarily wanted to dive into the decomposition of why yields are rising. I think there are a multitude of factors behind the rise in yields. There is expectations of stronger growth. There is also expectations of stronger inflation. There's likely a term premium, and there's also expectations of larger deficits. So it's all together that those factors are pushing up yields. I think what was very interesting was his response to whether he and the Fed would lean against this rise in yields because it leads to tighter financial conditions. And his response was very clear. This tightening of financial conditions needs to be persistent for the Fed to react. So far, it's not been persistent. He actually alluded to what happened last October, when we saw a similar run-up in yields, and then a couple of weeks later, yields fell back down. So I think they will want to see the dust settle in the next few weeks to see whether there is persistence in this rise up in yields and this tightening of financial conditions, and really what is driving that. It doesn't seem to be a de-anchoring of inflation expectations, for instance.
The other thing that I think is interesting, and he referenced, and you just referenced the 5%, or close to 5%, maybe for a day that we got to for the 10-year, but that was consistent with an equity market correction, a full-blown correction for the S&P 500. This time, the rise in yields has occurred in conjunction with this really strong rally across risk assets. If you're just looking at yesterday, typically that kind of move in yields that you would see, like we saw yesterday or over the past several weeks, would not be consistent with a rally in small caps or a rally even as strong as we've seen in the S&P 500. It's that magnitude of the move in yields that tends to put downward pressure on the stock market. So it's interesting because, at least for market-based financial conditions, yes, you get a tightening if yields are going up, but it's typically not consistent with the tightening if you're also seeing risk assets go up. It would typically be the opposite direction. That's why financial condition indexes yesterday didn't really move aggressively in one way or the other, because you had that offsetting pressure from rising yields but also rising stock prices. So I think that's probably a more interesting thing to monitor. What level of yields ultimately does trigger maybe a little bit of a problem or an issue or a sell signal for equities.
Is there a level you'd be watching?
I mean, 5, I think, is the one precedent that we have. It's a sample size of 1, of course, so it's hard to say. I do think that the rate of change matters much more than the level, but of course, if we're going to be dealing with a persistently high level or maybe an elevated floor, whether it's for inflation or whether it's for bond yields, that's a little bit of a different story, because the disinflation story has been so strong up to this point. But if things were to change based on, again, labor policy and or tariff policy, I think that would be more of a material mover for the market.
Let's talk a little bit more about the elephant in the room, Donald Trump. I think he's going to be the elephant in the room for the next 4+ years, right? When it comes to the markets and economic policy. Powell was very careful to say, we don't know. He didn't say this explicitly, but effectively he said, we don't know what he's going to do. We don't know what effect the economic policy is going to have. We don't even know what economic policies he's going to put into place. The market has kind of decided that it's going to be great, right? If the market's a discounting mechanism, it seems to have made that decision. Like how, as somebody who's setting some strategy here, Kevin, how do you think about it?
Well, it's interesting. I was looking this morning at, if you go back to 2016, right after Trump won, the period from the election to up until Inauguration Day, you did have this really strong rally and, the so-called Trump winners, which have been actually almost the same industries, sectors that have been rallying at this point. If you go the year after that, those were actually the underperformers relative to the so-called Trump losers. So I think it's part of a broader story and what we always, try to relay to clients, where you can't necessarily make these sector calls or industry bets on what's going to do well, especially this early in the game, in the stage of the election. We haven't even gotten to Inauguration Day. So I think that's the main message here, where you can't just take one day and extrapolate it. Even if you were to look at some of the internals in the market yesterday, breadth for the S&P was good. I mean, you were positive, but it wasn't exceptional and not nearly consistent with what you would see for a market that was ripping more than 2.5%. That's not inherently a bad thing, but you do have to consider the fact that it wasn't necessarily an everything rally. A lot of what was rallying and leading the market has been lagging so far in the first couple of years of this bull market, was certainly lagging in the first year of the bull market. So I think that's an important context.
Greg, you must be getting questions from clients about the Trump agenda. And listen, we don't know, to Powell's point, we don't know exactly what's coming up. We know what Trump emphasizes, right? It's taxes, tariffs, deregulation. But what are you telling clients when they ask you that?
Well, I think it all depends on what is going to happen over the first 100 days and then what's going to happen at a later point in time. We were talking earlier about the fact that a lot of the potential changes to tax policy and trade policy will have an effect towards the back end of 2025 into 2026 and 2027, so not necessarily immediately.
And the tough part is, Greg, there's so many different variables, because if you're talking about tax cuts, is it going to be like a one-size-fit-all corporate tax cut? Because sometimes you'll hear Trump allies and they'll say, no, we're talking about something more targeted. You want tax cut, you better be about U.S. jobs, U.S. manufacturing. I mean, it gets complicated.
Well, the one thing we know on the tax front is the expiry of the Tax Cuts and Jobs Act. So a lot of household income taxes are going to go back up if nothing is done at the end of 2025. That will be something that will likely be prolonged. How long, how broad it is an open question. But with Republicans having control of the Senate and perhaps even of the House, there's a greater likelihood that we see a full or near full extension of the Tax Cuts and Jobs Act, maybe not for 10 years, but maybe for 2 years or 5 years, that essentially keeps tax rates at a lower rate. The key important fact here is that it's not a tax cut per se. It's a prolongation of existing tax cuts. The other question that's important for businesses across most sectors is whether there is sufficient momentum to drive the corporate tax rate lower. That's not changing. That's currently at 21%. So is that going to be brought down to 15%? And then questions like bonus depreciation, R&D expensing, those are key for businesses to drive stronger investment. And those are opportunities actually for stronger growth going into next year.
So when you said first 100 days, it reminded me, Julian Emanuel of Evercore ISI, out today with a note. He said in the first 200 days, I believe, we will see the S&P 500 get to 6,600. Does that make sense to you, Kevin?
I mean, momentum is a powerful thing. So I think if you were to continue to see the kind of momentum that we've seen this year, which so far the factor of momentum for the S&P has been having its best year since 1999. So you can certainly see that. To me, it would be more important to look at what's getting you there. Is it a resumption of the trade that you had for a good chunk of 2023 into the first half of 24, where it was a smaller group of stocks, not just 7, but a smaller group that was leading you there, a significant increase in the number of members that were underperforming the index. That has clearly flipped since the midsummer, and I think that's been the best part of the market backdrop since the midsummer. So if it was that backdrop, then I think that would be an all right thing. I think it's just way too early to tell. And I do think that from a valuation and a sentiment perspective, if you were to combine those, given the fact that we are in relatively frothy sentiment territory, and you're also seeing valuations that are stretched across the board, across virtually every metric that we track, that in and of itself is not a risk for the market to just turn imminently lower. But it does, sort of increase the vulnerability of the stock market in general in light of a negative catalyst that approaches. And that's sort of to be seen, especially as you're going through a transition for the administration. But that just shows you that the playing field that we're now on is just a little bit more vulnerable than where we were.
Do you think, Kevin, there's probably some viewers who are watching right now and they've seen the action in the markets the past 24 hours. I've got green on my screen again today, and they're thinking, maybe I should be restructuring my portfolio. Good idea, bad idea?
Well, I'm always in favor of doing it based on what your needs are. We haven't been as much in favor of calendar-based rebalancing because there have been so many volatile swings across asset classes, but even within U.S. equities, within sectors. And so we've thought that taking advantage of those, maybe about letting your portfolio tell you, not the calendar tell you, makes a lot of sense. So if there are areas that were moving strongly yesterday where you felt underexposed, for a good chunk of this bull market, which a lot of investors have, because you look at stock versus flow, the stock of areas like tech is still really strong. The flow has come down a little bit. We're not yet seeing this massive flow and surge into the more cyclical parts of the market, but that to me would make more sense if you were trying to get more exposure, especially because even with the strength that you've seen over the past couple of days for a sector like tech, the leadership shift that has happened since mid-July has been pretty amazing for the rest of the market. It's not that tech has dramatically underperformed and has even fallen. It's just given a lot more runway for other sectors to start to participate, and I think that's been a relatively bullish backdrop.
Guys, thanks so much. This was fun. Appreciate it. Kevin, Greg?
Thank you.
Great to be here.
Have a good one. The Federal Reserve making its second rate cut in 7 weeks, cutting rates now by 25 basis points, with Fed Chair Jay Powell detailing the central bank's decision and its confidence on the state of the economy. Let's get back to Jennifer Finance's, Yahoo Finance's Jennifer Schonberger, with the details. Hi, Jen.
Hey, thank you, Julie Hyman. There are 3 things that stood out to me from this press conference. First, the Fed chair wanting to say as little as possible on the election outcome and the impact on the economy and what it means for the path for monetary policy going forward. He says in the near term, the election has no impact on the path for monetary policy. Looking farther out, he says there's just too much uncertainty. When these policies start to take shape, then the Fed will begin to model those and take them into consideration with other factors that impact the economy. He says this is just one of the factors that impact the economic outlook. Now, the Fed chair was pressed on whether President-elect Trump tried to fire him if he would leave. Fed Chair Powell simply responding no. When pressed again whether the president has the authority to do so, he says it's not permitted under the law. We know under the Federal Reserve Act that the president would need just cause to fire a Fed chair, and just cause typically is defined as malfeasance, which is probably not something that is germane in this situation. Secondly, I would just say that the Fed chair did not want to show his hand at all on December and whether a rate cut is still in play. He kind of seemed to say that both sides are on the table. He really wanted to keep his options open. He says the outlook for the path hasn't changed in that the baseline is still downward. They are still looking to cut rates to achieve their dual mandate. He characterized the labor market as solid and still seems to think that inflation is moving back towards their 2% target. And the fact that they removed key language in their statement today surrounding that sort of put an exclamation point around having achieved that test, that they have gained the confidence that they need, that inflation is falling. Today's rate cut was another move towards the recalibration. Take a listen to what the Fed chair had to say.
We continue to be confident that with an appropriate recalibration of our policy stance, strength in the economy and the labor market can be maintained, with inflation moving sustainably down to 2%.
And the third takeaway is the chairman's comments on Treasury yields. We have seen those back up. However, the Fed chair is saying that the Fed is just watching that closely right now. They're not taking that into account as far as setting policy. Guys?
Jennifer Schonberger, thank you so much. Appreciate it. Well, that concludes our Fed Day coverage. Of course, we'll still be talking about the Fed, and market domination begins on the other side. It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is Market Domination.
Tune in daily from 3 to 4 p.m. Eastern. welcome back. It's time now for Market Domination. I'm Julie Hyman. That's Josh Lipton. Let's take a look at the market action following the Fed cutting rates, announcing it's cutting rates by 25 basis points. We got our press conference from the Federal Reserve led by Jay Powell, and seeing here the S&P equal weight is up about 0.25%. The Dow right now is up about 61 points or so. You see a little bit of gyrations. Really, you've seen some volatility throughout the day. The Nasdaq up 1.5%, and this S&P up 0.8%, Josh.
Yeah, you thought you were going to get a cut of 25. You got the 25, Julie. A couple other points. I mean, listen, as to what's ahead in the December meeting, Jay Powell telling you, listen, I got a lot of data between now and then. I got a jobs report. I got a couple inflation reports. Politics came up. It was the first question out of the gate, right? What do you think about the election win, the Trump policy agenda? Jay Powell saying basically, listen, I don't know the substance of the agenda. I don't know the timing of the agenda, so I can't possibly tell you the impact of that agenda.
Right, exactly. So, really sticking to message there, saying he would not step down even if he was asked to do so.
Very clear answers.
By President-elect Trump.
No,
exactly.
I believe is it.
No, very terse. And you see here the 10-year yields have been continuing to move lower throughout the day. This is a bit of a correction from the last couple of days of action where we saw really a big move up in yields. So we're coming back down towards where we have been, and still not getting to 5%, which is the level that we were just talking about with Kevin Gordon as one that might start to be more problematic for stocks.
All right, let's get more perspective on this. Because bond markets reacting to Donald Trump's election victory on Tuesday as expected, with Treasury selling off sharply following that win. And joining us now to discuss the bond market outlook under Trump is Michael Pond, Barclays Global Head of Inflation Market Research. It is good to see you as always, Michael. Let's start with the Fed decision, Michael. What do you make of what the Fed did and what Jay Powell said at that presser?
Well, he didn't say much as far as the outlook. He said that they're going to continue to watch the data. The data supported another 25 basis points today, and that's pretty much all we got. He did push back pretty hard against the possibility of stepping down should it be asked by Trump. That's really good for signaling of Fed independence from the administration, which is important when we think about the longer-term inflation expectation outlook.
Hey, Mike, it's Julie. It's great to see you. So is that kind of what the market wanted and needed to hear from him, just sort of that steadfastness in terms of that independence?
Yeah, that's right. The Fed needs to continue to send that message that they are independent from the administration and will control inflation if it gets too high. They will do whatever they think they need to do without outside influence, without political influence, because generally politicians want a stronger economy, regardless of the inflation outlook. They don't want a weaker labor market. That's not good for votes. And so you really need that disconnect so that when the Fed needs to do what it needs to tighten policy, as it did a couple of years ago, they are willing to slow growth in order to get inflation down. That's what the Fed needed to do in 2022. They did that, and that's part of why we're seeing inflation lower today.
Mike, I'm curious, in that presser, a reporter asked Jay Powell, about yields and the backup there. And the reporter asked, why? Is that, expectations of stronger growth, or is it, expectations of rising deficits? And unsurprisingly, Jay Powell didn't want to weigh too hard into that. I'm just curious to get your take, Michael.
Well, he didn't want to have to respond to the fact that they've been cutting rates, and yet longer rates have been going up. So despite the fact that over the past couple of months, they've lowered short rates by 75 basis points, mortgage rates are actually higher over that period. That's not really what their intention is, but over time they think that short rates are really the only thing they can control. They can't control that the market is now pricing in a higher fiscal outlook, more fiscal expansion, likely because of expected extension of quote unquote Trump tax cuts, leading to higher deficits longer term that the Treasury will have to fund with higher debt levels that the market absorbs through higher yields.
So, Michael, when those clients at Barclays, they asked you, hey, Michael, tell me, where's the 10-year going to be 6 months from now, 12 months from now? You say what?
We think it's about steady. So we're not expecting any big moves in 10-year yields, but what we do think the market should be pricing in is more concern over longer-term structural inflation risks because of the Trump win. So right away, the market priced in higher concerns over tariff tariffs pushing through to higher inflation next year. That was almost instantaneous overnight. And the front end moved about 40 basis points higher when it came to what it's expecting for inflation next year. But forward inflation expectations, so 5-year inflation 5 years out, the market showed no concern that policies such as higher deficits, potential for a less credible central bank, or significant slowing in immigration, which leads to a tighter labor force, the market's showing no concern that those factors could lead to longer-term structural inflation. We think they should be, not even from a baseline perspective, but just from an inflation insurance perspective. That we think the market should be buying inflation insurance here long-term.
That's really interesting that you say that because, Powell himself was very firm in saying we don't know what's going to happen. We don't know what policies will actually go into place. So it sounds like you're not necessarily sure either, but it doesn't hurt to at least, to your point, take out that insurance, if you will.
That's right. So let's just think about tariffs for next year. So on the campaign trail, former President Trump floated the idea of a 60% tariff on all Trump imports into the U.S. and a 10 to 20% tariffs on imports from everywhere else around the world. If that was fully implemented and fully passed on the consumer, we think that would be worth about 90 basis points on next year's inflation. However, we don't think that's ultimately what will get passed. We think it's if we get tariffs, it'll be much more targeted. And what we saw in the first administration under Trump is they implemented tariffs, but it was so targeted that it really didn't have much of an impact on inflation. So, we could say that the market fairly reacted by raising 40 basis points for next year's inflation expectations, or that it underreacted by 40 basis points or overreacted by 40 basis points. So there's a lot of paths that policy could take, which could be very different from the campaign trail promises.
Michael, great to have you on the show, and thank you for that analysis. Appreciate it.
Absolutely. Great to be on. Thanks.
And coming up, we check in on a few of today's top trending tickers when market domination returns.
Now let's get to some of today's trending tickers. You can scan the QR code that you can see below to check out the best and worst and most traffic stocks of the session on Yahoo Finance's trending tickers page. Let's start with AppLovin on a tear today, up 44%. That company handily beating third quarter earnings estimates here. The shares, by the way, are up like 500% this year. Did you see that, Josh?
Incredible.
There is a decent amount of short interest, but not maybe as high as you might expect. But definitely you're seeing something of a short squeeze here. I mean, so it was running up into the report to be sure, but the company still came out ahead of estimates. It's a mobile gaming software company. Third quarter ahead. Fourth quarter also, the forecast is also ahead of estimates.
Yeah, Michael Pachter over at Wedbush. You know I'm a fan of Pachter.
I do know that.
Rates this one outperform. Target is 270. He looked at the results, told his clients, we see little downside to the stock at current levels. Believe that if top-line growth and EBITDA contribution margins exceed our estimates, AppLovin's share price will continue to appreciate.
Interesting.
Better times even ahead.
Apparently the company, according to another analyst, Jefferies, James Heaney, also is doing an e-commerce pilot, and he's very excited about that. He said it is the best product they've ever released. So a lot of enthusiasm.
A lot of excitement. All right, moving on. Shares of Mercado Libre are heading south. The Latin American e-commerce giant missing third quarter profit. So this one, listen, it looks like they grew their overall credit book from a year earlier. Provisions set aside of all the lending, that did cut into net income, which clocked in at $397 million. That did miss what the street had modeled. Overall revenue, $5.3 billion. That meets estimates, but we can see the stock really taking a hit today.
So this company is kind of like an Amazon plus a fintech, but minus cloud is my understanding of Mercado Libre. And like Amazon, it ramps up and down its spend, particularly on logistics. So there was a ramp on logistics spend during the quarter. It seems like analysts at least are pretty understanding of that. That's why part of the reason why you see that earnings per share number missing estimates. But then you also had this big provisioning within the credit business. So that was something that definitely hit the company. But total users for that e-commerce arm, 61 million people, monthly active users. The financial services part of it, 56 million monthly active users. So they're growing very, very quickly. It's just sort of uneven in terms of the profitability during that growth period.
And prior to this report, the stock had jumped about 35% this year, had a nice run. It actually became Latin America's most valuable company per Bloomberg, but now obviously getting hit hard in today's trade.
You know, we've been talking all about the AI trade this year, but we have also, hand in hand, talked about the utility trade, the power trade. Shares of Vistra have been part of that, and their shares are rising further today after reporting earnings that topped expectations. The shares up some more than 7.5%, topping 250% on the year in terms of how much they've gained. You see there, the earnings beat was pretty substantial here. A lot of it coming not from retail customers, but from their different areas of the grid around the country. And the company also is just talking about doing more business with the hyperscalers.
Yeah, and as for the financials, did raise its ongoing operations adjusted EBITDA forecast for the full year, now seeing $5 billion to $5.2 billion. AppLovin, we're just talking about that. There's another chart. Look at this. I mean, just a stunning move, about 250% this year. Yeah. And even then, still on the street, they love this name. I eat 14 buys, 0 holds, and 1 lonely sell.
Yeah, on the call today, the Chief Strategy and Sustainability Officer saying that the company's in early discussions with some of the hyperscalers, the cloud companies that we talk a lot about, to upgrade nuclear plants to increase power output. So that is an area that you and I have been talking a lot about.
A lot of interest.
Yes. Yep. Let's get to our call of the day now. Bernstein downgrading Ford in a new note from outperform to market perform. Joining us now, the author of that note, Daniel Roska, senior analyst at Bernstein. The share's down a little bit here today. So talk to us about what was behind that downgrade, Daniel.
Yeah. Hey, Julie, thanks for having me. The main worry we have is that the big discount bonanza that Stellantis is unleashing on the market, probably about $6 billion of discounts in the next couple of months, will severely deteriorate the U.S. market for all OEMs, but also Ford in H1 next year.
With Ford, Daniel, the stock's already been, beat up this year. Were there any? How does valuation look to you for a name like that?
Yeah, look, valuation on the auto sector is low, as you know. It's trading kind of at 5.5 times, 6 times PE. That's at the lower range of its long-term range. But if you actually look at free cash flow and then think about what's going to happen next year with the earnings coming down and then the working capital kind of winding up as the business slows down, we're forecasting free cash flow down at about $4 billion for 2025. And that actually puts it bang in line with its long-term free cash flow yield at about 11 to 12%.
Daniel, what happens to the F-150 in 2025? What do sales look like? And, this has been just a monster for the company, but how threatened is that business?
Well, look, I don't think it's threatened, first of all. As you say, look, the F-150 and the franchise behind that for the F-Trucks, 250, 350, that's really the heart of the Ford franchise between Ford Blue and the business segment Ford Pro for their business customers. And we have confidence and also see upside for that business in the medium term. But again, with Ram coming in with significant discounts on those cars, they're going to see pricing headwinds in the very near term, and they will not have the opportunity to react and cut costs in H1 25. That's something they'll need to get ramped up into the second half. And so I think the franchise is strong. We're really signaling a short-term headwind on pricing into the first half of 25.
Daniel, I'm curious, a broader question. We had the election. We've now got a result. Trump is heading back to the White House. How are you thinking about possible implications for your coverage universe?
Yeah, we've written about this extensive, and of course, it's a big question with investors. I think what's going to happen is, number one, the new administration very early on, kind of, I think late January, early February, will go back and change the DOT and EPA emission targets. We think they're going to make it a lot easier and basically remove this kind of forcing mechanism for the US OEMs to ramp up their BEV sales. That's exactly what they also did in 2016. So they're just going to wind back the clock on the emission targets for US OEMs. We also think they're going to make it a little bit more difficult to gain the 30D tax credit. So that makes the consumer side on EVs a little bit more difficult. We think they're going to be a little bit more narrowed and targeted on how they're going to deploy those incentives. And that means overall, we're going to have some hangover for EV growth in 25 and then probably also into 26.
Well, Daniel, hadn't most of the automakers already been set up to meet those targets? And so now are they going to have to sort of change strategy in reverse? Or does this, I mean, on balance, I guess, is it good or bad for them?
There are three parts. I think number one, short term, 25, for automakers like Stellantis, Ford, and GM, who are not making that much money with EVs, who are actually losing money on every EV they're selling in the US, this is positive news because it limits the losses they're going to have in EVs. In the medium term, you're absolutely right. They've put CapEx to work. If you look at the CapEx plans of the major OEMs in the US, the market was planning to go to about 50% of EV penetration by 2030, which would have been not quite enough to reach Biden's emissions targets. And so now that's something they'll need to rethink. They will need to be more flexible and reallocate some of that capital, probably push it more into plug-in hybrids and hybrid drivetrains to kind of bring that up in the next couple of years. But long term, I think the question really is, what if the US OEMs slow down on innovating on electric vehicles? Will they lose touch to what's happening in China? Will they lose touch to what's happening in Europe? And so if the US automakers kind of don't find that domestic demand for EVs and curtail their investments to get better at making EVs, I think there's a real long-term risk that they're missing out on the technology for the next decade.
That's the U.S. market. Also, interested to get your take on the Chinese market. Will all that stimulus help?
So far, the stimulus is not specific enough to auto. So when I talked to my analyst colleague in China, the stimulus really is broad-based, and it's not specifically targeted at vehicles yet. And so we haven't really seen that change too much. We're actually seeing the inventory pile up a little bit again in the EV channel. We're seeing kind of significant EV production growth, but no demand pickup. And if we now think about 25, channel inventory going up, demand indicators into 25 are not really seeing a teens growth in China. It's kind of mid-single digits probably. I think we're not going to get rid of the pricing headwinds we're seeing in China into 25.
Daniel, thank you so much. Really appreciate it.
Thanks, Julie. Thanks, Josh.
Well, we're wrapping up today's market domination. Don't go anywhere. We've got you covered with all the action following the closing bell. That will include a conversation with the CEO of Lyft, David Risher. Following that company's latest earnings report, Lyft shares soaring over 20% today. Stay tuned for market domination overtime.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot. Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetista, your favorite financial educator. Welcome to Capital Gains. We're off for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
There's the closing bell on Wall Street, and now it's market domination overtime. We're joined by Jared Blickery to get you up to speed on the action from today's session. Let us start with the major averages here on this Fed day. The Fed cutting by 25 basis points and not really giving a lot of clues about what is going to happen next, even though most market participants pricing in a quarter point cut again in December. But Chair Jay Powell not really giving a lot of indications about that or indications going into 2025. All of that said, we do have the Dow finishing the day little changed, really. A lot of gyrations through the day within a pretty tight range. The S&P 500 here gaining, when all is said and done, by about 0.75%. We're getting some wackiness on the interactive here. And then the Nasdaq, the gainer that won on the day, up 1.5%. Interesting here to see the Russell 2000, which had an absolute huge gain yesterday of nearly 6%, now falling on the day by about 1/3%. Ironic, because this is a group that is seen as vulnerable to higher bond yields, but yields fell today. They were up yesterday. Go figure. Jared, maybe you can decode all of this for us.
Yeah, I think it's all about growth. If you have higher yields because the economy is growing, then, well, small caps are going to participate in that. But you're right. The reason seems to change on a day-to-day basis as to what exactly is a catalyst here. So bottom line, we're giving back some of the gains in the Russell 2000, and there is a little bit of mean reversion considering the huge movements that we saw yesterday. So let's take a look at the bond market here. We saw a little bit of a reprieve, down 8 basis points. Here's what's happened over the last 2 days. You can see, well, down from those highs that we saw 2 days ago. Let me put it in context of the year today. This will be a little bit better. Still camping out near these highs here, and I'm going to be talking about this and the implications for risk markets with Josh in about 30 minutes. But the other thing I wanted to focus on before I get to our heat maps is the VIX. Here's a 4-day look. The VIX has survived some of the most incredible macro developments this week that you could imagine, and it is at the lows right now. So there is just a lot of fear being priced out of the market, and that's for the most part a good thing. Let's go to the heat maps here and check out the sector action, where tech, communication services, and consumer discretionary, the 3 mega cap sectors, those are in the lead here. So big kind of winning the day. Financials, after having the best day in a few years yesterday, they were leading the way down today, down about 1.5 percentage points. And then industrials and energy also off about 0.5% there. And if we take a look inside the Nasdaq 100, we'll see that mega cap action, Meta up 3.5%, Alphabet up 2%. So is Nvidia, so is Apple. Just a lot of catch up here. And if we go to, I don't know if I have the Mag 7 ETF, MAGS, but that recently, here we go, it recently broke to a record high. Here's the year to date. Kind of struggling there, then just popped. We got a lot of markets, even transports, that have just broke into the upside, and we'll have to see if they continue here, Josh.
Thank you, Jared. Tech stocks, the standout on Wall Street after the Fed cut rates by 25 basis points as expected. The Nasdaq and the S&P 500 closing at new record highs. And joining us now is Sebastian Page, T. Rowe Price, Global Head of Multi-Asset and Chief Investment Officer. Sebastian, good to see you.
Great to see you.
So let's start with the Fed today. You expected 25, we got 25. What did you make of the decision, Sebastian, and also Jay Powell's presser? What did you learn today?
So it's been a stressful week for the country. I think the country is sleep deprived. And the Fed, no drama.
Yeah, drama free.
Growth is fine. Inflation is fine, but the core is a little bit elevated. And we're not ruling in or out a cut for December. You see rates coming down a little bit today. I like to look at the forward contracts, and they're showing rates by the end of next year at around 3.7%. So now we're at 4.75 on the upper bound. No drama in a week that's been stressful for everybody. So thankfully we're good here.
Yeah, and I guess you wouldn't call it drama, but the Fed chair was very clear and concise when he was asked if he would step down if Trump asked him to. He said no. So it sounds like we are stuck with him for the next, call it, year and a half or so. There's always a lot of debate about whether the Fed has done a good job. What do you think? Do you think that they are, at this point, doing a good job doing what they're supposed to be doing?
I think they are. But it is unusual for the Fed to cut when spreads are so tight in credit markets, when stocks are at an all-time high, when unemployment is only 4.1%. Yes, it's rising, but the average unemployment over the last 30 years is 5.6%. So it's a little bit unusual to cut that much, start with 50 basis points in this kind of macro environment. In the background, I like to look at inflation swaps. What is the market thinking about inflation? And you have a one-year contract you can look at. It was at 1.7% a few months ago. It's at 2.5%, so it's really trending up. And there is a risk to inflation over the next 12 months that maybe the Fed is not fully considering, perhaps. But we don't know.
Let's bring that back to the stock market, Sebastian. So, you just heard Jay Powell sounding broadly constructive on the data he's seeing. Earnings growth is decent. You've got good seasonals now. I'm sure you have clients who come to you and say, what's not to like about this stock market? What do you tell them?
Okay, just for fun, let me give you the bear case. Yeah. Manufacturing PMI is at 47. That is a contraction. The yield curve has been flashing red. It's disinverted. That's usually a recession signal. And, we do have an increase in unemployment. And historically, when it starts increasing, it's really hard to stop, from 3.4% to 4.1%. I'm giving you that bear case because I take issue with it. And I agree that the broader picture is much better. City economic surprises up for several months. GDP now, the nowcasting, is up about 50 basis points from the beginning of the year. The Fed is easing. We have fiscal pedal to the metal, 7% of GDP. And
is all that priced in?
It's a lot of it is priced in. I mean, look at credit spreads; they're really tight.
Well, at what point is it too priced in? Not only the scenario you're describing, because the market seems to be on the same page as you in terms of being bullish right now. Now, though, it's also pricing in what seems like fair skies, as far as you can see, under the new administration. Is the market pricing the a Trump trade appropriately right now? Do you think?
So if I look at the market's reaction yesterday, because I think today we're just normalizing some of that reaction. My view is that the market is pricing in deregulation, lower taxes, and inflation. Now, that's, I think, a reasonable reaction based on what was said on a campaign trail. And however, and you saw it, especially for deregulation, you saw small caps, energy, and financials. These are all sort of reflective of that deregulation. Taxes, a lot of promises were made, and inflation, you saw the market move. So, these moves seem appropriate to me, but if you ask me what is the market missing, it's maybe sort of a short-term view reaction to the uncertainty coming out. And when uncertainty comes out, stocks love it, right? So there's some of that.
So is it more that than the prospects of tax cuts and deregulation?
I think
it's more just a giant sigh of relief that I have an answer.
That's the fourth factor. So to me, the three key factors are deregulations, lower taxes, and inflation, which is not necessarily positive. You got to watch. And just a sigh of relief that we have an outcome and it's potentially pro-growth. But the one thing that maybe the market is not fully considering right now is, trade wars can have real consequences, real economic consequences, and that can rattle stocks. And we're kind of pushing that can down the road. I think we're not thinking about that enough right now.
So you're looking cross-asset. That's your purview. I know you've got a little overweight in stocks.
Yeah.
Where are you guys on bonds right now, given what you've just been talking about and the potential risks?
If you look at our multi-asset portfolios, we have a little bit more cash than our strategic weights and a little bit more stocks, which means we're underweight bonds. So we're short duration. So coming into this, seeing rates come up, that's good when you're short duration. I do think, though, that if we travel all the way to, say, 5%, and we remain in a cutting cycle, there will be opportunities to deploy cash into bonds, just not right now.
Well, we'll be talking to you, I'm sure, again soon, and so we'll see if
And
that's the time.
And I'll be happy to come back and tell you.
Sebastian, great to see you. Thank you.
Thank you.
Appreciate it. Well, let's take a look at Airbnb. That company shares are surging as the third quarter results hit the wire, up about 8.5%. Our Akiko Fujita is breaking down the numbers here. What are we seeing from Airbnb, Akiko?
Yeah, some strong numbers coming through, Julie. Pretty much in line with street expectations on the top and bottom lines, but the company raising its outlook for Q4. Earnings coming in at $2.13 a share compared to the $2.15 analysts were expecting. Revenue in Q3 coming in at $3.73 billion. That marks a 10% growth year on year. Gross booking value, a key metric for the company, coming in higher than estimates, $20.1 billion compared to the $19.8 that was expected. And then average daily rates, though, just seeing about 1% growth when you compare it year on year. Nights and experiences booked, $122.8 million. The street was expecting $121.27, so that a beat as well. Some commentary coming through from Airbnb talking about a strong Q3, saying that they saw some of that growth accelerate in the latter half of the quarter. But with that said, the company is raising its outlook as a result of that momentum. They've seen revenue for Q4 now expected to be in the range of $2.39 to $2.44 billion. That would mark a 8 to 10% growth year on year. The company does say it expects the take rate, though, to be slightly lower, given the one-time benefits from unused gift cards they saw in the same period last year. Now, a few things to note here. Quality control, something this company's really focused on over the last year. Seeing some results on that front. They say they've removed 300,000 listings over the last year. And then expansion markets, something that CEO Brian Chesky has talked a lot about. Airbnb saying the average growth rate of nights booked on an origin basis in expansion markets was more than double that of their core markets. They specifically highlight Brazil, although a big chunk of the revenue still comes from their core markets. Investors on that call certainly be looking to 2025, when Brian Chesky has talked about additional services that will be announced, more expansion, and how much of that will add additional revenue streams coming through for the company, guys.
Akiko, thank you so much. Appreciate it. Lyft shares riding high following better than expected guidance and third quarter revenue. The ride-sharing company lifting its full-year outlook as both driver hours and active riders reach all-time highs. And joining us now is Lyft CEO David Risher. David, always great to see you and have you on the show. So you report, David, investors clearly like what you had to say. Your stock surged 23% in today's trade. Walk us through the results, David. What are you seeing in the business?
I'm seeing customer obsession that's driving profitable growth. Excuse me. It's in a sense, it's sort of the story we've been telling for a while. I've been on the job maybe 18 months now. And the focus from the beginning is how can we obsess on our customers, our riders and our drivers? Over the last 18 months, you've seen the results. So record high rides, record high riders, record high driver hours. Even Halloween a couple of days ago was just a monster of a day. Up significantly over a big Halloween last year. So I think it shows that when you pick people up fast, you price well, you do a good job, increase the service level, great things happen.
David, I'm really intrigued by the growth in people commuting via Lyft because of some of the new initiatives you've introduced here. So you saw that people were seeing this price lock feature that was really feeding into that. What proportion of the riders now are commuting? And how much do you expect that particular aspect to grow?
So it's such an interesting thing. So first is, the answer to your question is about Monday through Friday, it's about half of our rides are commute rides. So it's a very significant thing. And you can understand why. People go to work, they come back from work, so it's 2 rides a day typically. And people do it, typically a couple, 3 days a week. So very significant part of the business. What do? We introduced a product called Price Lock. Price Lock gets rid of this just hideous, artifact of, whatever, econometric science of sort of supply-demand balancing, which pops the price up when demand is higher than supply. You can't get rid of it completely, but as I said last quarter, we've opened up a can of whoop-ass on it. We're really trying to drive it down. We've driven it down about 40%, super significant, so you shouldn't get anything like those big price variations that you've gotten in the past. And then we allow you for about $2.99 to lock in a price. So that if the price ever bumps up against that limit, you'll never ever pay more than $13, $14, $15, whatever your average daily commute is. You put all those things together, and it's a great product. We've sold about 200,000 passes already. Actually, that was back in September. We've done more since then, and people really like it. And that's just a very long way of saying if you do great service, people respond, and these are the results.
David, I want to talk about competition as well, because I spoke with some analysts who cover the space, and they'll say, listen, one issue is that Uber just has this bottom line scale advantage. They're just bigger and they can pull levers whenever they want to. They can get promotional whenever they want to. So how, against that, David, how do you execute consistently quarter in and quarter out when you're dealing with just frankly, just a bigger competitor?
Yeah, I don't think scale is an advantage for them. I really don't. And I hear this all the time. People say it, and I get the thesis, I guess. But I would also say focus is an enormous advantage. We do rideshare, and we do it really well every single day. It's what people wake up every morning and try to do better. And for all the discussion of, well, they've got all these different sort of levers they can pull, they also have all these different distractions, all these different things that can go wrong. Something goes wrong in a part of the world where we're unexposed. I'll actually put myself, our own company, back in the mix. We just opened up a new partnership last week with DoorDash. It's a great partnership. It means that anyone who's a Dash Pass user can now get Lyft benefits, and Lyft riders can get Dash Pass benefits. So it's a sort of save on both. I call it two great tastes that go great together, like the Reese's Peanut Butter Cup thing. Anyway, it's great. So it's wonderful for our riders and drivers, our riders in particular. People have adopted it super fast just over the last week. I encourage everyone who's listening to link their accounts. You'll get great discounts. But it's probably not something that the other guys were thinking about. They probably thought they had a pretty clear line with their loyalty product without having to deal with this. So my point is just that I think focus and excellence really pays back. And I think we have plenty of scale at 2 million rides a year, 800 million rides a year. Gosh, we've got plenty of scale to buy in bulk, give great service, give great discounts when needed, and so forth. I don't see it as a disadvantage at all.
David, speaking of partnerships, let's also talk about autonomy, right? Autonomous vehicles, because you guys also separately had announced a new partnership here. Give us the details and, again, sort of what you expect it to do for the business and how quickly.
Sure. So it was actually 3 partnerships, and I'll touch on at least one, maybe the other 2 if we have time. The first thing I should say is autonomous vehicles are coming. And if you're here in San Francisco, you see them all over the place. You see some in Texas and some in Phoenix and other parts of the country as well. It's definitely happening. It's a safe experience. They know the rules of the law. They follow the rules. They don't text. So all these things. So it's going to be a good experience. Now, it's very expensive for the manufacturers. Very, very expensive. So they're all trying to figure out who can we partner with that's going to increase asset utilization, right? Like take these very expensive cars and put them out on the road, as quickly as they can, so that they can start making money on it. Now, what's one of the deals we just signed? We just signed a deal with a company called Mobileye. Maybe people know about them, maybe they don't, but they've been a company that's been doing autonomous technology for years and years and years. And their AV tech is already in, if you're driving a Honda or a BMW or a Volkswagen or a Ford or any number of things, lane assist, where it kind of pops you back in the lane, or adaptive cruise control, that's often their tech. That's called level 2. Level 4 is full self-driving. And that's the deal that we just signed. As they develop full self-driving technology, and as that technology starts to show up in the next 2, 3, 4 years into the Fords of the world, let's say, it means that anyone who buys one of those cars can push a button and have that car be on our platform. Right? So think of it. You can come home at night, a long day, push a button, your car goes, picks people up, drops them off, comes back the next day. And we do the fleet management, and we do the demand generation, and so on and so forth. Obviously, that's a future vision. We're super clear on that. But we're trying to build a world where, just like individual drivers today can put their asset to work, in this case, their car and their time, tomorrow, those same people can put their car to work, and they can go off and either take a nap or do another job. So that's the sort of vision we're trying to build towards, is sort of a hybrid. You've got drivers, you have robots, and hopefully everyone is economically doing well, and riders are getting a great experience.
Look forward to seeing it all play out, David, and to have a car without a driver come pick me up, even here in New York. Appreciate it.
For sure. Well, you can still take our bikes too, Julie. I know you're a biker sometimes.
I'll tell you my secret one about bikes when we're off camera sometime. Thanks a lot, David.
That sounds good. All right, good to see both of you guys, as always.
You too. Take care. Coming up, we're going to speak to the CEO of Upstart Holdings following the company's latest earnings report, as those shares are soaring after hours. Stay tuned. More Asking for a Trend still to come.
Upstart holding shares, they are surging right now. Look at that. After the company reported Q3 earnings just moments ago, delivering a beat on both the top and bottom lines. And joining us now to discuss all this and the report is Dave Gerard, Upstart CEO. Dave, it is great to see you. So you report, also get the guidance here. You see Q4 revenue about 180 million. The street was closer to around 163 million. So that's an easy beat. Stock is popping. Walk us through the report, Dave.
Yeah, well, our business has kind of gotten into a nice growth mode again, and we're moving really quickly. We're introducing new AI models, which are sort of the underpinning of how our system works. Better models lead to better conversion. More automation leads to higher conversion. So that's all what's happening. That's leading to an acceleration in the volume on our platform and in our financials.
And Dave, how are rates playing into the volume increase? Because, as we are acutely aware today, the day on which the Fed announced another rate cut, rates on that sense are coming down. Benchmark rates are coming down, but we're not necessarily seeing actual rates come down, right, in terms of treasuries, which I assume you guys peg your lending rates to, at least in part. So how is that sort of playing out in terms of the effective rates that you're lending at on the platform?
Sure. Rates on our platform are still probably fairly close to an all-time high. As you say, the benchmark rates have moved down a little bit, but relative to a couple of years ago, they're up a lot. And the other thing is the risk in the environment is still high. The American consumer has kind of overspent and is still a little bit sort of behind where they should be on the personal savings rate, things like that. You put that together, really means rates continue to be quite high. I mean, they're beginning maybe to come off a bit. So the growth isn't really coming through, rates falling that way, really coming through things we're doing with the models itself, the improving AI models that improve conversion. But I think any sort of large reduction in rates, whether that's from the Fed or the benchmark rates, or just sort of a change in the consumer behavior, that's all in our future.
And I'm curious, Dave, you all are, of course, an AI lending platform. How do you see, Dave, AI evolving from here, and how is Upstart well positioned to leverage that?
Yeah, it's interesting how, ChatGPT just a couple of years ago, turned this whole thing on fire. We've been an AI company for a long time, really focused on a very specific flavor of it, predictive AI, for helping inform credit decisions and really making the credit origination process really work well. So we're still at the beginning of that journey. The exposure that AI has gotten, I think, is a great thing for us. We have more than 100 banks and credit unions that are on our platform that use our AI to originate credit. And the fact that it's gotten to sort of the meme level it has in the industry is great, because that means every bank, every credit union, they're bored, they're talking about AI, what's their play. Everybody knows the world in this regard is changing very quickly, and that's certainly helpful. We're not the only ones out there kind of trying to explain what AI is, why it can be safe and fair, and all the things that an executive should care about.
You guys returned, I believe, to positive EBITDA after, a couple of quarters, and you predicted that next quarter will also be. And then is that it? Are you back in the plus column for the foreseeable future?
Yeah, I mean, we've been a public company for almost 4 years, and for a lot of that, we were GAAP profitable, EBITDA profitable. Last couple of years, really, as the lending environment deteriorated, we lost that profitability, and it's definitely been a goal for us to always get back there as quickly as possible. We've now gotten back to EBITDA profitability. The next stop on the journey will be GAAP profitability. Most of that difference is stock-based comp. That is the difference between those. But yeah, I mean, we're a company that I think for a long time was both fast growth and profitable, really good unit economics, and that's the company we're becoming again.
What's the timeline for GAAP profitability now then for investors, Dave?
We don't know that yet. I mean, we've just forecast EBITDA profitability for the last quarter of the year that we're in here now. But certainly it's our goal in 2025 to return to full GAAP profitability and go from there.
All right, Dave, thank you so much for your time. Appreciate it.
Thank you.
Got some more earnings for you now. Taking a look at Pinterest now, which reported third quarter numbers. Those numbers beat estimates, but revenue guidance seems to be what is sending those shares down. There's a look at the third quarter. Our earnings per share beating by a comfortable margin here as did revenue by a bit. The fourth quarter revenue forecast from the company is $1.13 billion to $1.15 billion. Analysts had been estimating 1.15. And of course, this is the holiday quarter that we're talking about here. So a big decline in the shares.
Yeah, and the stock heading into this print, I mean, Julie, it was already down nearly 10% this year. So it was already under some pressure. It's interesting. I'll just be on the call. I'm curious to hear how executives just talk and characterize the overall ad environment, because we've had other reports and results that indicated it looks fairly steady. So I'm interested in that. Of course, always trends in monthly active users, average revenue per user, and you can be sure there'll be questions about the Amazon partnership as well.
Yeah, in the third quarter, the company also saw a pretty decent increase in its monthly users, 11% increase to 537 million. That was better than had been estimated. You know, it's interesting. We were just talking to Dave Gerard about how Upstart is using AI in its lending algorithms. Pinterest has talked a lot about how it's using AI to suggest things to its users and to make the best use of that. So they'll probably talk about that on the call as well. And again, to your point, they'll get questions about what's going on with the fourth quarter and why they're not seeing a better return on that as people not only pin things, but can actually shop through the site and what they have on their boards.
All right. Moving on, it is time now for What to Watch Friday, November 8th. Starting off on the Fed, we'll be getting some commentary from a couple Fed officials, including Fed Governor Michelle Bowman. Bowman, the lone dissenter, remember, of the Fed's 50-point basis point cut in September. The Fed cutting by 25 basis points earlier today. Fed Chair Jerome Powell saying in a news conference after the decision that he continues to be confident in the strength of the labor market and economy. Investors will listen closely for any clues on what the Fed's next move might be as the country braces for a new president.
And taking a look at earnings, Paramount will announce results for the third quarter before the opening bell. Analysts expect the company's streaming numbers will improve with an estimated 3 million gain in subscribers on Paramount+.
And finally, NVIDIA is joining the Dow, the tech giant replacing Intel as a component of the Dow Jones Industrial Average. Starting tomorrow, NVIDIA will join alongside paint maker Sherwin-Williams. Change is effective before the opening of trading tomorrow.
That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's Asking for a Trend. I've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned. Hello and welcome to Ask for a Trend. I'm Josh Lipton, and for the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we're going to be diving into. Federal Reserve Chairman Jerome Powell staying put, whether President-elect Trump wants him in the job or not. In the news coming after the central bank cut interest rates by 25 basis points as expected. We've got a deeper dive into the future of the Fed and monetary policy that is straight ahead. Plus, more earnings are coming out this hour. We've got a roundup of the results from automakers, Rivian and Lucid, what the results say about the health of the EV market straight ahead. And the Nasdaq and the S&P 500 closing at new records. We're looking at the takeaways of the trading day. Well, the Federal Reserve continues its rate-cutting cycle, the central bank cutting rates by 25 basis points. Fed Chair Powell not only making remarks on policy and the economy, but also clearing up questions about his future under the incoming Trump administration.
Some of the president-elect's advisors have suggested that you should resign. If he asked you to leave, would you go?
No.
Can you follow up on, do you think that legally you're not required to leave?
No.
Well, for more on what could be ahead for the Fed, we have Serpa Pinto Advisory founder John Hilsenrath joining me now to discuss all this. John, it is great to see you. You are, of course, the perfect man, John, to talk to on a day like this. Nobody knows more about the Fed. Let's say, John, you're a reporter again, John. You're at your chair. You're under deadline here. You got to write the lead for this Fed decision, for this Powell presser. What is it, John?
Well, two things. My lead in a financial publication would be that the Fed opened the door to slowing the pace of rate cuts. I'm actually surprised more people haven't been talking about that. But, Powell said pretty clearly when asked that they're starting to have a conversation about when and how to slow down the rate cuts. My own view is that it's going to feel like this rate cutting cycle was over before it even started. So they did the second rate cut today. There's a decent chance they'll do another in December, but they're going to be talking by early next year, possibly by December, about slowing that pace down. And I think they're going to be done cutting rates by the middle of next year. So that to me is the big news. And then obviously you highlighted the second, which is, if Powell gets pressure from the new president and his administration to step out of his job, he doesn't plan to leave until his term is up in 2026. That, by the way, is coming up right around the corner. Next year, 2025, is going to be full of speculation about who the next Fed chairman is going to be, nominated by our new president, Donald Trump.
And those 2 points, they do potentially connect, sort of, John. Like if you say, let's say it's early 2025, and Powell, the Fed, they're looking at the data, they say, you know what, it's time to take a breather here. Let's just assess where we're at. It's possible, of course, that does not, a pause wouldn't exactly go over that well with our president-elect.
Exactly. What we've seen in Donald Trump is that he tends to take interest rate policy and Fed decisions somewhat personally. That was the case when he was president in 2017 to 2020, and we could see that again. So Powell will have cut interest rates by almost a full percentage point before Trump is sworn in. But here's what Powell is thinking as he looks out to 2025. They want to get their target interest rate to what they call neutral, to a policy that doesn't stimulate the economy too much and doesn't restrain it too much.
What do you think, hey, John, just to start, what do you think that is, by the way? Is it 4, 3?
Right,
below?
well, yeah. Right, well, that is the big question. They right now they say it's around 3%, but Powell will be the first one to say they don't know. They're not sure what it is. And so as they get closer to where that is, and they're going to be in the 3s next year, they're going to want to slow the pace to make sure they're coming in for what they would call a soft landing on rates. And, we'll have to see how patient the president is with it. The subtext underlying everything is inflation. This election that we just passed might have been, was in many ways was determined by the American households' impatience with the high cost of living. So there's only so far Trump can push the Fed to cut interest rates, because if he sets off more inflation, that's not going to make his constituents very happy.
One last political question, John. Let's say there is some tension next year between Trump and Powell. I don't know. And Trump, he criticizes the Fed. He goes after Powell. At the end of the day, so what, John? Could you say, am I being too cynical? Does it matter if that happens? I mean, listen, Trump's a tough guy. Jay Powell's plenty tough. I mean, you don't get to those positions unless you can, take and throw punches. Would it even matter?
Yes, it will matter on several levels. So one level is this: the Fed puts out forecasts. They'll be updating their forecasts in December, and they forecast 3 years out. So, when the Fed forecasts where it thinks interest rates are going to be in 3 years, what matters more? What Donald Trump says interest rates are going to be in 3 years, or where Jay Powell says interest rates are going to be in 3 years? He's not going to be around in 3 years. So what the president says does matter, because it shapes the interest rate outlook beyond the time when Powell is still going to be there. It matters. I mean, the president's views matter also for regulatory policy. One of the reasons why financial stocks are rallying right now is they think that the Fed and the other financial regulatory institutions are going to be under a lot of pressure to deregulate. The Fed has been in the middle of a debate about what kind of capital adequacy rules to put in place. I think we can see a lot of pressure on the Fed to ease up on some of those ideas. So yeah, the president will matter very much in concrete ways in how the Fed is communicating and some of the decisions it's making, particularly on the regulatory front.
John, it's always great to have you on the show, but especially on Fed Day. Thank you.
Thank you so much.
The S&P 500 and Nasdaq hitting records as the Fed cuts rates. Yahoo Finance's Jared Blickery joins us now with the trading day takeaways. Jared.
Well, I thought we'd begin with the Trump trade. As nebulous as that is, we're going to try and dissect it for you, and we're going to go to our heat map in a second here. But let's pull up the Wi-Fi Interactive where we can take a look at the Trump trade. And let's I'm going to pull up a 2-day look at first. These are some of our leaders. I want to show you what's happened in sector land. We were just talking about financials with John Hilsenrath. Financials had their best day in 2 years yesterday. Is that part of the Trump trade? I think people are getting a little bit ahead of themselves. And so what I'm going to do, I'm just going to focus on the price action here. Tech, consumer discretionary, financials, communication services. So the Mag 7 plus financials, those were outperforming. Take a look at these leaders right here. Bitcoin, unprofitable tech, that's ARK. Regional banks, look at that, KRE up 12% yesterday. Small oil software. There's just a lot going on here. The worst off, cannabis and solar energy. And what's interesting, Josh, is way back in 2016, everybody thought solar energy was going to do terrible under Trump and traditional energy is going to do great. It was the opposite.
That's what I wanted to ask you. So how do we compare and contrast?
Well, that's the difficult thing. I think we're just going to have to wait and see this out. But I just want to point to a couple more things here. This is where I'm focusing most of my time here. Tesla just had this huge breakout. Let me show you a 2-year chart. There we go. It's 300 is this big honking level here. And in fact, I'll take this to a 5-year. 300 was in play way back in 2021 when that was the high. So we're just getting back to some really big levels. Tesla could break out. Look at Amazon. Amazon just broke out. Here's the 5-year chart. It's up at record highs. Just broke up within the last 2 days. So my point is there's a lot going on to get excited about in the market. I don't think we need to label it Trump or anything else.
Point taken. Number 2.
Fed up. Yeah. Are we? I don't know. I don't have a lot of commentary on the Fed presser here.
Drama-free, really.
Yes. I mean, look, Powell is not having a lot of questions about the election. I think he was just...
Although they tried. They really tried.
He got enough of them, and I think we got the flavor. The Fed's going to do what the Fed is going to do. The bond market didn't react that much. Stocks are still at record highs, so I don't think we need to parse it that much. But having said that, there are some really interesting things to look at in the dollar and in rates.
So that's where you'd be tracking those two, rates, Dixon.
Dollars and cents,
Okay.
you bet.
Yeah.
All right, so let's go back to our charts. We're going to take a look at the U.S. dollar index and rates. I think we'll start with rates because the 10-year T-note yield has been heading higher. 4.4%, I believe, was very close to the most recent high. Here's a year-to-date chart. I've been showing this a lot. This is that big run-up since the September lows. And normally, a move like this up in rates, that would spell problems for equities. Yet, through most of this, equities were hitting record highs. A lot of this based on growth expectations. So if rates are heading higher because the U.S. is growing, the economy is growing, that's a good thing. And I think that's why we've seen even small caps participating. But you get too much of this action, too high a yield, too high a dollar, and suddenly that starts weighing on equities. And I think we go any higher, I said 4.4% was probably going to be too high. We go much higher, that is going to be, we're going to see a tipping point there. So as I've been fond of saying, watch the dollar, and we'll see if I can find the U.S. dollar index. Here, very similar story here. It is off of its highs as well.
And so, by the way, is there one metric, one data point I should be tracking here, keep my eye on? That's it.
Bitcoin?
Oh, yeah.
Bitcoin, watch Bitcoin. I think Bitcoin is actually the biggest risk on indicator. It's been leading a lot of the reports, or leading the equities off a lot of the reports, even the bond market sometimes. So I'm watching Bitcoin in reaction to a lot of these big catalysts. It got the election. It was pretty excited about the election, I'd say.
Jared, thank you, buddy. Appreciate it. Coming up, shares of Rivian are higher following their latest earnings report. We're going to break down the numbers on the other side. Stick around. We're asking for a trend. Still to come. All right, we've got the latest earnings report from Rivian out today, and Yahoo Finance's Braz Subramanian joins us now with the numbers. Braz.
Yeah, Rivian bouncing around here now up in the after-hour session. Revenue came in at $874 million versus the $980 million expected. An adjusted loss per share of 99 cents, wider than the 92 cents that was initially expected. But more importantly, it revised its adjusted EBITDA guidance to a loss of $2.82 billion to $2.87 billion. That's higher than the $2.7 billion they had originally seen. And this is due to a supplier issue that they previously disclosed. There were some issues at the factory, but they said that they still expect a modest gross profit in Q4, which is, I guess, that means that basically their costs are coming down, cost of goods sold is coming down, and the company reiterated its guidance for 50 to 52,000 vehicles delivered at the end of the year.
All right, so that was Rivian.
Yeah.
What about Lucid? What
Lucid
do we do there?
Lucid shares here actually looking pretty good here. Last time I checked, what's going on here is
nice pop, 9%
pop. A better revenue than expected, 200 versus 196.3 million. Adjusted loss per share of 28 cents versus the 31 that they had originally been seen. Deliveries better than expected in Q3. Company still sees annual production of 9,000 units for the year, which is good. But more importantly, the Gravity SUV, their upcoming EV SUV, is still on track for production later this year. Higher end trims first, then the lower end trims will come out next year, hopefully targeting $80,000, which will be right below that EV tax credit threshold, which, if it still remains following the election, that's another story. But right now, they're on track to get that SUV out later this year and then cheaper trims next year.
All right, Pras, thank you, buddy. Moving on, gold prices sliding to a 3-week low yesterday on the back of President-elect Trump's victory. The precious metal trying to make up some of those losses today as the Fed continues its easing cycle, cutting interest rates by 25 basis points. For more on the moves in gold, we're bringing in Luc Gimon, Alamos Gold COO. Luc, it is good to see you. It's the first time we had a chance to speak to you, Luc, since you reported results. It looks like you reported gold production for Q3 that beat estimates. Stock was higher today. It has soared more than 45% now this year, Luc. But walk us through the quarter. I'm curious, what are you seeing in your business?
Yeah, look, I think certainly from our business and our sector, we've seen a very positive environment for the gold market. It's continued to stay strong, and I think really a function of us being able to deliver has been really related to our strong performance consistently quarter over quarter. On the basis of our gold production and our all-in sustaining costs, we've been able to continue to deliver consistently on our results over the last number of quarters, and I think it's obviously been positive, certainly for our share price over the last couple of years.
Luc, a different question for you. We obviously had the Fed decision today. They cut again. There is the expectation, though, Luc, that maybe we could see fewer cuts coming. Trump policy, expectations of faster economic growth. If that was the case, Luc, what would that mean for bullion?
Well, look, I think, if you look at the bullion market, certainly since the elections being finalized there the other day, there was a substantial drop in the gold price of about $80. There's been some gain to that again. I think if you recall with the last election process when Donald Trump was elected, there was the same sort of kind of reaction to the market with regards to gold price dropping and then rebounding. So I think, it's just a point in time. Obviously, I think the long-term fundamental trends are still there for the long term for gold. I think it's still a solid investment. And certainly when you look at the market on the U.S. basis with the amount of debt that they have in the market, the gold is still a very strong play for investors over the long term.
Who's buying gold right now, Luc? I mean, is it retail investors or it's mostly those central banks?
Yeah, I would say it's been mostly the central banks. They continue to accumulate quite a bit of gold, and they've been on that trend for quite a while. So I really don't see that, changing as far as that landscape. I think it will continue.
With a Trump win, Luc, you would expect to see, a more friendly, I think, regulatory backdrop, a more friendly regulatory environment, more friendly antitrust division at the DOJ. What could that mean for your company and the industry broadly? I mean, you guys are busy with M&A already.
Yeah, we've been very busy with M&A. I mean, I certainly think our profile really just internal growth that we have. I mean, I think that's been a real driver for the market as far as Alamos and an investment into Alamos is just a lot of the internal growth that we have ourselves that we've been looking to deliver on. I mean, if you look at our production profile where we are currently, and we're projected to be coming at about 575,000 ounces of gold production this year. But with our internal growth profile, with our pipeline of projects over the next couple of years, we're looking to bring that up to about 900,000 to 1 million ounces of gold production. So certainly the trend we're on with the market, I think it's going to continue to bode well for us for the long term and the sector in general itself.
And Luc, obviously you have competition. I mean, for investors who may not be familiar, what would you argue sets you all apart?
Well, I think it's the track record. It's delivering, right? I think, obviously the market, when we look at consistent performance, both on gold production as well as your all-in sustaining costs and cash costs, we've continued to deliver on that. The other aspect is obviously on the growth profile with regards to the pipeline of projects. It's the capital projects. And, on the market aspect of what we communicate to the market is delivering on time, on schedule, and certainly on budget with regards to those capital projects. So I think that's another important factor to wanting to continue to invest in Alamos Gold.
And finally, last question, Luke. You know, we did mention the M&A, the Argonaut acquisition you all have done. What did that mean for the business?
Yeah, look, I think with regards to the Argonaut acquisition, and specifically Magino, which is now in our portfolio, it's really solidified our district within that region, our Island Gold operation, which is right next door. We were already under a substantial expansion with our Phase 3+ expansion that we were undertaking there. And with now adding Magino to that complex, you know, our gold production is going to climb to about 400,000 ounces annually from that district. So it's really a core asset of the company for the longer term. We've got some obviously other, you know, bigger visions and bigger plans there with regards to that district itself. We're looking at evaluating actually building a bigger mill complex there as well to be able to increase production even bigger for the long term. We have an extensive land package there as well, which provides a lot of exploration opportunities within that district for the longer term, which supports a bigger mill complex for the longer term as well. So we're quite excited with that asset, and it's something that's going to remain in our portfolio for a number of years as we move forward.
Luke, great having you on the show today. Thank you for joining us.
You're very welcome. Thank you.
And coming up, I'll get you caught up on a few more earnings that have stocks buzzing after hours. All right, now let's get to some trending tickers that are moving after hours. You can scan the QR code below to check out the best and worst performing stocks of the session on Yahoo Financing trending tickers page. Shares of Block, let's start there. They're falling after hours. The company reporting third quarter earnings that met expectations, but revenue did fall short of analyst estimates. Q3 revenue coming in at $5.98 billion. Company also maintaining its full-year gross profit guidance. Shares of Affirm also under pressure after hours here. Company reporting first quarter results and boosting its gross merchandise volume forecast for the full year. Affirm also seeing second quarter revenue between $770 and $810 million. Analysts had estimated about $783 million. And finally, shares of DraftKings under pressure after reporting third quarter results. Sports betting site reporting a wider loss than expected, while revenue also came in light of analyst expectations. The company also cutting its revenue guidance for the full year, citing a weak start to the fourth quarter. That is a wrap on today's Ask for a Trend. Have a great night.